All right, good morning, everybody. Excuse me. Good morning. Welcome to the room. Um, Nice to have you guys here today. Hope everybody's doing well. Hope you're excited to follow some rules, learn some patterns, find some successes, and maybe face some challenges. That's all part of the learning process. We're going to cover an awful lot of stuff today. We're going to watch the live market. We are going to review charts and see what you guys have been doing. But before I do anything, guys, each and every day, I go to forexfactory.com/calendar and I check news. I make sure that there's not something going on that may create an emotional response in the people that move the market, that control the market. So today is Tuesday, April 2nd. And at 10 a.m., you'll notice that Jolt's job openings is a high impact news. This is something that can create challenges. It can make people react emotionally, dump a bunch of money into the market, pull a bunch of money out of the market. And the reality is you really don't ever know what the response is going to be. You don't know if it's going to be positive or negative, up or down. Um, so, as a general rule of thumb, understanding when these emotional reactions may happen is kind of the first advantage that you give yourself every day. Um, because we are going to trade patterns that repeat themselves over and over. We're going to trade a solid set of rules that create advantages, but there are people that wait for news releases, and that's the basis of their trading plan. Um, and we just don't want to get in their way should they decide to move the market. So every morning I go to that forexfactor.com, I check news, set a timer, write a note, 10 a.m. today. It's going to be potentially a bumpy ride. And then, guys, I wanted to share this one because I think that we forget this every now and then. So I hope this doesn't fall on deaf ears. The key to everything that we do in this classroom, guys, is having a foundation, creating a solid foundation, learning to be a chart reader, understanding really three very simple concepts to use for trade entries. And then every week, you're going to add to that. You're going to compound. You're going to really obtain more and more clarity. So for you new users, Cedeno, welcome to the room. Nice to have you. Um, I blanket with very conservative rules, guys. Recognitions of advantages, and I'm going to hand you a solid plan that really optimizes your chances for success. So part of that whole routine, and I'll just go ad lib here, is that I'm going to be very conservative, and I'm going to tell you that as a brand new user, not having momentum or trading into areas or not having the perfect entry isn't advantageous, and it's something that should be avoided for the new users seeking success. And not because that's the only way that you can ever trade with the software, but because I really want you to focus on the best of the best, to build a foundation, to understand your basic chart reads so that from there you can grow. Anything and everything that you need from Nexgen, anything and everything that you need to be successful comes right from the education page. We go to great lengths to not hide anything from you, to make it as simple as we can and really focus on your success. The software user guide. This is your NinjaTrader how-to. Cleaning out data for the day, opening charts, building charts, scaling charts, stops and targets, using your capture software to be able to participate in the room, um, connecting to your Ninja account. All the things that you need for NinjaTrader, especially if you're brand new to NinjaTrader, are just a click away right here in the software user guide. But if you have any questions about your NinjaTrader during the day, please feel free to ask. That's what the classroom is for. And then the second one is just the tutorial section. And this is where you're going to be able to find descriptions of the rules, pictures of the rules being met. You're going to find multiple trades, how to do market replay, volume flow analysis, all this different stuff. But what we're going to do initially is we're going to keep stuff really simple. And I want to go to the glossary of common terms. And I want to highlight one thing for you right here, guys, the high probability trade. This is a trade when each indicator on every chart agrees for the trade. Good morning, JW. This is when triggers are their strongest and no termination conditions exist and there's no trouble spots between your entry and your target. And guys, this is the first trade that we talk about every day. So for those of you that are new, We're going to spend really an hour, hour and 15 minutes. We're going to talk about this high probability trend trade. We're just going to focus on the rules. Good morning, Miss Adriana. We're going to focus on what those rules mean to you, what they look like, and we're going to do it because it's going to turn you into a chart reader. And that's my goal for everybody. I mean, everybody wants to be a day trader, right? But you can't be a day trader until you're a chart reader because you have to know what it is that you're looking for. And one of the great things about the high probability trend trade, good morning, Miss Cindy, is that it creates these advantages. It gives you the opportunity to take a trade that typically wins 70 to 80% of the time. It creates confidence through the memory of success. But the most important thing and the first skill that it's going to allow you to master is becoming a chart reader. Because chart reading really is about 90% of your day. We all like to be busy, but the reality is that it's not busy that pays the bills. It's a statistical advantage. Every time you pull the trigger on a trade, you're doing so because rules are met and because rules have been proven to win more than they lose. And if anything has made its way into your trading plan that doesn't offer a statistical advantage, well, then you really need to consider rethinking your trading plan. But chart reading is going to have you understanding where the market is likely to continue, and that becomes the entry for the high probability trend trade. It's also going to let you know where the market is likely to go. This is going to have you formulating a management plan that allows you to capture the most out of the moves. And then finally, it's going to have you understanding where the market is likely to stop. And for us, these are what we call termination conditions. And these areas not only tend to put an end to the trend, but they also they behave as an anchor for the highest probability trend trade that you can take. When one of these likely to stop areas reverses the market, we call that a strong top or a bottom, and that's the precursor to that trade that typically wins 70 to 80% of the time. So we're going to focus not initially on becoming successful day traders. We're going to focus on becoming successful chart readers. And from our chart read comes the little second step here, which is trade entry precision. That's hard to say. You're going to be able to use this on simulator. You're going to be able to go through and not only take the rules that we talk about, but also be able to back test them, to prove them correct, to learn to trust them. And it all revolves around getting in where the market is most likely to continue. And then from your great entries, you're going to be in a position to be able to manage these trades. And history has proven that the better the entry, the easier management becomes. So there's a pretty simple path to get to where you want to be. The path hasn't really deviated over the years. And it all begins with posting your trades in class, guys. Showing me what it is that you're doing. Talking about how you're reading the chart. Showing me where you entered, where you exited. And what you'll find is that when I review charts in the second half of Classroom, that I do so with the idea that we're looking for advantages, that I'm looking for the least amount of risk on your entries, and I'm looking for the highest profit potential. And we're looking to work together hand in hand through your submissions and my feedback to getting you to the point to where you can repeat everything that you're doing, that you can do the same thing over and over because you're proving to yourself that it wins more than it loses. So posting in the room is the first part. Sorry, I got ahead of myself. Making sure that you're telling me everything that you see, guys. This is my chart read, Mark. This is what had me in that long trade or that short trade. This is where I entered and this is where I exited. And how can I do it better? Or did I do it as well as I possibly could have? Which happens a lot of the time. You guys are pretty amazing. And then the second half is once you post those in the room and you get your feedback, is go to the spreadsheet that Nexgen gave you. I drop this in the room every day, guys. This is loaded on your computer when you download the software. There's also a link to it directly in the tutorial section, but I just dropped it in the room for you. And there's 4 tabs on the spreadsheet. There is the copy of your trade tracking, guys, and this is your trade journal. This is where every time you take a trade, win, lose, or draw, you're going to drop it into the spreadsheet. And you're doing this for a reason. I'm not just giving you busy work. You're going to talk about what it was and how it did and how you felt and what the advantages were. And then there's a notes section here that allows you to take the feedback that you receive in class, drop it in the side there. Because what you're going to do with the spreadsheet, page 1, is every morning you're going to study the day's trades, the previous day's trades, and you're going to ask yourself what worked and what didn't work and what felt easy and what felt forced, right? What felt like you were trying to make something happen rather than just taking what the market was giving you. But this brief historical study each morning, guys, it sets you up for the day. It has you focused on advantages. It has you focused on patterns that repeat themselves that are bringing you success. And then the second half of that is if you notice in this notes sections that you continually trade in determination conditions, or you find yourself trading without momentum, or perhaps even that you just hold trades longer than makes sense, is you're also going to be able to recognize patterns in yourself. You're going to recognize these patterns that may be helping you, that may be hurting you, and repetition is the key. The second page is where you take pictures of everything that we're going to learn in this first hour. Each section is divided into a rules met and then a rules not met. And the more pictures you take of your rules being met, the easier it becomes to recognize your rules in the moment. Good afternoon, Jen. The third tab is your favorite look. So when you take a trade that fits the rules, when you take a trade that provides that statistical advantage, when you take a trade that is everything that you're looking for in a trade, you're going to drop a picture of that here in the personal trade setups look. And this is how you're going to create your plan, guys. You're going to take your ability to read charts, and some of you are going to recognize trend trades wonderfully, and some of you are going to recognize momentum trades. There's even some of you that take these crazy counter trend trades that win more than they lose because you've done the study to make it happen. And that's what the third tab is. You're building your trading plan. And then finally, the fourth tab is where I've done an awful lot of work for you guys. I've gone through and I've put about 300 pictures of you guys using the software, annotated charts, looking at advantages. We've put the entry sequence for both long and short trades for the high probability trend trade, a very mechanical management beginner plan. A lot of you guys want to trade the NASDAQ because you see the more experienced traders trading the NASDAQ. Guys, the NASDAQ is like a caffeinated weasel in a blender. It's difficult to trade if you don't know what it is you're looking for. So I teach a little more focused on the S&P and crude oil, or maybe the Russell, things that tend to trend a little smoother. And then once you understand what you're looking for, guys, you can use this methodology on any time frame, any market. You can stocks, Tesla, Bitcoin, it doesn't matter. The patterns are the patterns. There's an awful lot about management, patterns that repeat themselves, termination conditions. And then my hope for you guys is that you fill up your favorite look section and really make it look like the work that I've done already. And I'm telling you right now, fill this up. Give 500 pictures in here, and you'll never wonder what's going on in the market. You'll be able to anticipate. You'll understand that your rules are met almost instantly. And it really will create this great advantage. So we're going to take the first hour and we're going to learn the trigger line and Fibonacci rules for when it's okay to trade. First hour feels very lecture-y, but please interrupt me if you need to. You guys simulate, post your pictures in the room. It's dropped. That's a lot. That's okay. The beauty of it, Cav, is that we can make money either direction, right? Let it drop. I don't worry about my 401k when I know how to trade futures. Guys, the idea is when you post in the room, once you taking rules, once you focus on advantages, I want you taking trades that provide a statistical advantage. And it's not for my sake, it's for your sake, because the idea is that you should be able to take the same trade 10 times, the exact same look, the exact same rules, everything, and you should be winning 7 or 8 of those trades. And if you're not, then it creates challenges. If you're getting lucky on simulator, you're building long-term failure habits because luck runs out, guys. It's almost like they have cameras in your office at home and they're watching you. And when you get lucky on simulator, it creates this false sense of security. And then when you get into the market live, man, you end up losing like the first 4 or 5, and then you try to revenge trade and things go south quickly. But if you're always practicing the correct rules, it sets you up for success for building muscle memory. Um, Simplify, 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 simplify. A lot of people believe that if 3 rules is great, then 4 rules must be better. And if 2 charts is enough, then 5 charts has got to create an advantage. But the reality is, guys, is that it's easier to find the perfect trade when you're only looking for the perfect trade. When you start giving yourself too many things to look at, when you start adding charts, when you start adding indicators, when you begin to look for 4 or 5, 6 different trades because you saw Bob in the room taking those trades, what happens is you look for everything and you typically find nothing. So I'm going to give you a rock solid plan that keeps you focused on 2 trades in the beginning, 2 trades that teach you to read your indicators, that turn you into a chart reader. And you guys need to be snapping pictures all day, 15 to 20 pictures a day, so that these looks become easy to you. So that's your path to get to where you want to be. Remember, the better you annotate your charts, the better the feedback is going to be for you. The more you tell me what you're reading, the easier I can help you with your reads. Make sure you're using that spreadsheet, and then let's get into it, guys. In the spirit of simplicity, this high probability trend trade is going to happen on 2 charts for you, ladies and gentlemen. Just 2. You're going to see more charts in the room, and it's rare that those other charts are creating any sort of advantage for the people using them. And very often I see them posting these extra charts, but I don't see them using them properly. So keep it focused, keep it simple in the beginning. You're going to get really 99% of what you need from the large chart. More specifically, you're going to get most of what you need from the first bar on the large chart, the most current bar. It's going to allow you to define direction, momentum, areas that may be problematic, or even areas that have been helpful. And this large chart's a broad stroke of a brush, guys. It's a slow moving train. It doesn't show change very quickly, but what it does is it shows the overall opinion of the market. It shows you what the people in charge want to have happen. And your large chart shows you what the large crowd are making happen. The large chart tells you when the large crowd wants it to go up and when they want it to go up fast. And the large chart will tell you when they haven't reached any areas yet, or that they've already cleared the areas that may be problematic. And the large crowd typically wins, guys. These are the guys that push the lazy river in the direction to the cantina. And if you fight that current, all you do typically is just wear yourself out. There is a small crowd, though, and your small crowd is what the small chart represents. And these guys love to fight the large crowd. They love to fight momentum and direction. And these guys give what we need as next-gen users a little shove against everything that the large crowd is trying to accomplish. And it's pretty amazing because we can use that little shove to pinpoint where the market is most likely to continue. It refines that broad stroke of a brush. What happens in 1 bar on the large chart is about 15 to 30 bars on the smaller, faster chart. And by doing that, you're really going to pinpoint where the market is likely to continue. You're going to understand these areas so intensively, I guess is maybe a good word, I don't know, that it's going to reduce risk for you, and it's going to allow you to maximize your profit potential. So large crowd is going to tell you which way the flow is, and the small crowd is going to let you get in so that you can go with the flow. And we're going to do it initially with a high probability trend trade. This is a trade that typically wins 70 to 80% of the time. What does that mean, new users? That means that you will lose trades. Go ahead and get used to that in the beginning. And don't worry about wins or losses as you learn your entries. Worry about the execution of the method. Talk to yourself in terms of advantages. Make sure that you're following a plan that's been proven, that's been back tested by hundreds of next-gen clients, and that has been proven to win more than it loses, because the goal is to win, guys. And this high probability trend trade is only 3 rules. That's it. 2 charts, 3 rules, 5 things to think about. The large chart always leads the way, and it says that you have to have strong triggers. And that's going to provide you the advantage of momentum when the rule is true. The large chart also is going to make sure that there's nothing in the way, that there's room to your profit targets, and that will provide you the advantage of a clear path. And then your small chart, that small crowd, is going to be used to pinpoint your entry. And that's going to give you that entry area advantage, getting in where the market is most likely to continue. And a trade is really nothing more than three advantages. A high probability trend trade isn't your desire for the market to go up or down. It isn't a gut feeling that maybe things are going to go your way. It's the accumulation of momentum, a clear path, and an entry area pieced together to create this highest probability trend trade. And rule number one says strong triggers. And strong triggers do two things for you. The first thing, if you hold out for strong triggers, you will always be trading with the direction of the market. If the background is green on your large chart, that market's going up. And because it's going up, the only direction the new user should be looking to trade is up, looking for rules to be met for that high probability trend trade, long trades. If the background is red, the market's going down, and the best advantage you can give yourself is to go with the flow, to only look for rules to be met for high probability trend trade short. And the cool thing is that the only way to have those strong trigger lines is if the colors match. If my background is green, well, then my small triggers, this fast moving indicator, must be green. And if my background is green and my small triggers are green, well, then my large triggers must be green as well. And this is a little safeguard for new users to keep you focused on the best of the best initially. When the smalls break above and away from the large triggers, when space is created between the two, this is my strong trigger look, and this is when the odds are favorable for the market to continue up. You guys will use that smaller, faster chart to buy Fibonacci support to go with the continuation of direction, with the momentum that's already been established. On the large chart, it looks like these tails or these wicks. But you guys are going to be able to pinpoint exactly where those tails or wicks are most likely to form by using that refinement chart. To the downside, small triggers below the large triggers. Large triggers are wide. They're angled in the direction of the trend. Guys, this is your strong trigger look. And when you have strong triggers down, you're going to be able to sell Fibonacci resistance on that smaller, faster chart. You're going to be able to pinpoint exactly where this tail or this wick on the large chart is most likely to form using resistance inside of favorable large triggers on the smaller, faster chart. And rule number one, the advantage of momentum, guys, this is likely to push the market in the direction of the trend. Strong triggers can break key areas. Fibonacci resistance, support. Very often when you see it break because of odds favorable momentum in play. And guys, it looks like the Russell's just on a huge downturn. So let's back up a little bit. And I want you to see a couple examples of strong triggers. When there's separation between the small and the large, guys, this is a market that's likely to continue up. And you'll notice that strength breaks an area. Smalls below the large are wide. Everything continues down. This first advantage, guys, and it's really a pretty simple look, is going to eliminate an awful lot of mistakes that new users tend to make. And strong trigger lines is the best of the best for taking the high probability trend trade. Strong trigger lines, guys, it can even cover mistakes, but strong triggers don't last forever. When there's separation, that's the easiest short that you'll ever take, selling resistance on a smaller, faster chart. But with both triggers still down, when one of the small triggers is inside, one of the lines is inside of the large triggers, good morning, Zorro, it's okay. I'll have you banging erasers at the end of class, maybe keep you after, write on the chalkboard, something. Guys, this is the first sign that momentum is slowing. When one of those lines gets inside, you can visually see that you're losing your advantage of momentum. You can see that the market is starting to slow down. And this is where you're going to rely on your ability to read charts, because if everything still agrees on the other charts as well, guys, you could still take short trades. There's still opportunities there. But for the brand new user, for the high probability trend trader, for the person looking to give themselves that statistical advantage as they learn to read charts, that's the best of the best. And then with both triggers down, once both of the small triggers are inside of the large triggers, you have a weakening or a slowing of the trend. Anything can happen is the term that you're going to hear in class. You can still take short trades, guys, but again, your chart reading is going to let you know if there's enough advantages in place, excuse me, to look for that final short. And then when you have these anything can happen triggers, these weak triggers, guys, when you reach areas, these are the areas that typically stop the market, that create bounces, that establish reversals, because the momentum is now gone. And this is our little segue to rule number 2. Is everybody okay with rule number 1? And it really doesn't have to be difficult, ladies and gentlemen. If there is separation between the two, you have strength. If there's separation, you have strength. If one line is in, it's decreasing. If both go in, look at the retracement, even in this huge downtrend. And you see it over and over. They're weak, and there's a push-up, and now they're going back. And they're weak, and now you're seeing this retracement. And guys, if you focus on the advantage of momentum, it's going to make life easy for you. So the most current bar in the large chart lets me know that the market is up. The background is green. The most current bar in the large chart is showing me that I have odds favorable momentum, that there's separation between the small and large. The scissors are open, if you will. So now I need to let the large chart define areas, and we're going to do that looking for termination conditions. Rule number 2 says that when I have the advantage of momentum, we're not going to skip it, termination conditions must be false. I must have room to my profit targets. This gives me the advantage of a clear path. And guys, a clear path means that there's nothing in the way to create a bounce. It's the easiest way to say it. Termination conditions are Fibonacci-based indicators that may reverse the market based on a comparison of the Fibonacci area and the T3 trigger strength and location. So the same trigger lines that establish momentum are going to be used to understand a couple very key concepts when we get to these lines. The trigger lines are going to let us know if the area is likely to stop the market, behaving as a termination condition. Your trigger lines are going to let you know if those areas have the potential to break, and your trigger lines are going to let you know if price is broken. Guys, these lines are where decisions are made by the big crowd. These lines are where the buyers buy and the sellers sell, where profits are taken, where fights can happen. And the reality is you're about to get this amazing recipe that allows you to avoid the fight, to stay out of the confrontation between the buyers and the sellers. So the first thing that happens is price reaches an area. It's a pretty simple concept. Your price bars reach the area, whether it's resistance or support. In this case, it happens to be support. Those dynamic Renko bars come down, they hit support. All you have to do is ask yourself, where are my trigger lines? And if the trigger lines remain above the area of support, you've reached an area that may reverse the market. Capital M-A-Y, reverse the market. It's not guaranteed to reverse the market, but it may. It's not guaranteed to create an untradeable bounce, but it may, which means that your clear path is gone, which means that your statistical advantage is out the window, which means that for the brand new user, the best option, the easiest option, the less stressful option is to simply do nothing, to wait and see if the market reverses or if the area breaks. So price reaches the area, triggers remain above, no more short trades. That's your termination condition recipe, and it's true on every one of those lines, whether it's Fibonacci support, red Fibonacci resistance, yellow 1-to-1, cyan divergence lows, magenta divergence highs. And guys, these are the lines on the large chart that let us know when decisions are being made. Well, these areas break all the time. They create bounces all the time. So if no triggers through means that the area is not broken, that it may reverse the market, then when both the small and the large triggers get south of support or north of resistance, we now consider the area to be broken. The path is once again clear until you reach the next area. So price reaches support and none of the triggers break, and you guys are sitting on your hands and you're being patient. Eventually, the small and the large get below support. It's behaving as resistance. You've got that odds favorable momentum, and you haven't reached the next area yet, which means that that's the perfect time to sell Fibonacci resistance on the smaller, faster chart. And each and every one of you is going to be able to pinpoint exactly where the top of that tail is most likely to happen to enter the market. So No triggers through, no trade. Both triggers through, the path is clear. Is everybody cool with that concept? Let's go through and see if we can find some examples of it. This is crude oil. Man, a lot of grindy markets today, right? So let's check it out. We'll come back a little bit. That's a 50-50. Crude oil's not playing very well today, is it? Almost hits resistance, retraces, goes up to the key area, comes down to support, it creates a bounce, the area breaks, creates another bounce, market goes to the upside. Look at those tails with odds favorable momentum, strong triggers breaking areas, resistance behaves as support, look at the tails, weak triggers creates the deeper retracement, ultimately the area breaks, the market continues up, misses its target by a tick or two. No, Paul? Did I do something wrong? Odds favorable, there's one of those tails. Odds favorable, there's a tail. The momentum starts decreasing, and it pulls right up to resistance, and none of the triggers break. So I'm just in this constant state of asking where price is. Yeah, CL is slow right now. I was watching it this morning. I'm like, just do something, and it didn't. And that happens sometimes. That's the 90%, right? When price reaches Fibonacci resistance and the triggers remain below, it's okay to do nothing. And thank goodness if you did, because look at the bounce right off of resistance. Your recipe to not go long kept you out of the long trade. And then it pushes all the way down to support, all the way down to this mid band. And guys, I want you to recognize where the large triggers are. This is a huge pattern that repeats itself all the time that's really going to keep you out of trouble. If price accelerates away from the large triggers and smacks into something, and those large triggers are a full bar away, price is more likely to close the gap to the large triggers than not, which means that this gap theory, as we call it, says absolutely no short trades. Let it close the gap. This is a termination condition, but this gap back to the large triggers lets me know that the mid band is behaving as a termination condition as well. So I can't go long. We hit resistance, the market pushes down, would have stopped us out. Hit support. Nope, just the large chart, Gino. The gap theory is a large chart phenomenon. And again, Gino, I know that you trade the NASDAQ, and there's very much a gap theory that's involved in the NASDAQ, but for what I'm talking about in regards to termination conditions, it is large triggers, absolutely, and it's the large chart. So no longs, no shorts, all the way back up to resistance, a divergence high, a second resistance, the triggers remain below, and guys, no longs. And this also creates what we call a pivot stop out. And this is one of the most misused phrases in the room, I think. This magenta line, this negative number, this means that there was a loss of momentum at the pivot. That's it. And guys, this calculation to create that magenta line isn't even true until somewhere down here. So price doesn't create this or doesn't reach this pink line. Price actually creates this pink line. But when the market comes back to the pink line, the magenta line, and the triggers remain below, now it's a termination condition. And then we have what's called a pivot stop out. And a pivot stop out means, let's get everything off of here, that price exceeds the magenta line and then trades back below. And now, not only do I have two resistances behaving as termination conditions, but now I have what's called a pivot stop out. A pivot stop out can be powerful. This is just a pivot. Over here, it's now a pivot stop out. So when price trades above a magenta divergence line and then back below, don't take any long trades. Guys, this is one of the most ignored termination conditions by most users. And they happen at both highs and lows. So here's a picture of one at the low. Price comes down and goes back up. A loss of momentum creates this cyan line to the right. And this is just a line in the sand. It's not a termination. Price didn't reach it. But when price reaches the divergence low and the triggers remain above, it's a termination condition. It becomes a pivot stop out when price trades below and then back above. And now, don't take any short trades. So guys, pivot stop outs, it's just a name of a particular pattern that repeats itself. When a pivot stop out coincides with Fibonacci resistance or support, it adds strength to the top. And then let's go to our next picture. This is a great one because it reminds us that strong triggers can break areas. This picture also reminds us that 90% of our day is spent waiting for advantages. If there were no entries all the way down to these yellow 1-to-1s, you're going to feel this little tugging at your heartstrings. I need to go short. I didn't get paid. I'm not making money. And it just broke through areas and it never gave me an entry. I'm going to try the short trade even though I reached 1-to-1s and the triggers remained above. And you're quickly stopped out, as happens more often than not in the termination conditions. But then I want you to see what happens, guys. And this is where fortunes are lost. From this termination condition, let's take a picture of the picture and have some fun with this. And we'll go through the rules, right? So price reaches yellow 1-to-1s, the triggers remain above, and that means it's a termination condition. No more short trades. And price retraces all the way to resistance and the triggers remain below. And well, that happens to be a termination condition as well, and I can't go long. And I can't go short because I don't have momentum, and I can't go long because it's still a termination, and I can't go short, the colors don't even match on my triggers, and I can't go long because it's still a termination, and then I can't go short. Why can't I go short? Because the momentum is up. And I can't go long in here because, guys, there's that gap theory. There's that mid band with a full bar back to the large triggers, and that says don't you dare go long. And eventually, guys, you get tired of waiting. And you're like, I'm never going to make any money. Nexgen's stupid, and I hate Mark, right? But all of this patience, and guys, this is about 45 minutes worth of shenanigans by the people in charge. This is your 90%. If you manage to sit through this and say, I don't have an advantage, well, once they give you momentum, and small and large get above resistance and it acts as support, guys, look at this. There's one of those tails. That's your green flag. That's the highest probability trend trade. That's your best chance of success. So what I want you to start training yourself in the beginning, and this is hard to do for the new users, is I want you to talk about advantages every time you look at a chart. Do I have the advantage of momentum? Do I have a clear path? And if the answer is no, as a brand new user, it's okay to do nothing. More often than not, it's going to keep you out of bad trades. And what I've found working with traders for the last 3.5 years is that it's not the trades you guys take that make you successful. It's the poor trades that you avoid. It's the money that you give away when it's unnecessary. And that tends to be what hurts traders more. So large chart uses lines. It uses lines to define trouble. Large chart says, hey, here's an area, decisions are being made, let's not trade into it. Or here was an area that reversed the market, let's trade from it. On your small chart, we're going to use lines for entries, but there is one termination condition on a small chart. Because this is a slow-moving train, guys, we can use a small chart to help us identify when the market may be turning without reaching an area, or even with a clear path, it ends up going up. And that's 3 divergences in the same price range. 3 losses of momentum in the same price range may terminate the trend. This becomes very powerful when your trigger lines on your smaller, faster chart go from odds favorable to anything can happen. And guys, this 3 divergences in the same price range, this is the only time where a small chart tells me that rule number 2 isn't met. This is the only time when I don't have a clear path because of the small chart. So if I see this at a low or I see this at a high, all it's doing is it's saying, Mark, don't take that last short, or Mark, don't take that last long. Things may be changing. Let's wait for it to settle down and see what happens. And what it does is it keeps me safe, and it allows me to use that smaller, faster chart to recognize the change on the large chart. So guys, we've kept it pretty simple so far. We're using a large chart. That's it. That's all we've looked at so far is a large chart. Large chart on the most current bar has defined direction. The background is green. I know with no uncertainty that I'm looking for rules to be met for high probability trend trades long. If I look at the trigger lines at that most current bar, does everybody notice how the smalls are above the large are wide, there's space between the two? Can we all agree, especially new users, let me know if you see it, that I do have that odds favorable momentum, that I am looking at a market that's likely to continue in the direction of the trend. And I also haven't reached Fibonacci resistance. And guys, that means this is not a termination condition. This is actually a target if I get an entry. And all of my trigger lines have gotten above the previous resistance. It's now acting as support. This one bar has defined direction, momentum, and areas. This one bar has told me that I have the advantage of momentum and the advantage of a clear path. Could you pretty please give me a Y in the room if you're with me so far? Because the large chart leads the way, guys. And if you can't see this on a large chart, finding entries on a small chart is going to be different. Everybody's got it perfect. You guys are so smart. Well, the rules are true. I'm going to the small chart. And I am going to refine that broad stroke of a brush. And I am going to use a limit order, which means I'm literally going to wait for the market to come to me. Thank you, Bob. Thank you, Paul. And I'm going to use that limit order at an area inside of favorable large triggers, guys. And if you say it in one breath, I am going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. I'm going to let the small crowd give me a pullback, a small retracement counter to the underlying trend, and I'm going to wait for that pullback at an area, fibs, midbands, yellow 1-to-1s. Remember, the large chart told us the areas that were problematic. The small chart is going to use them to define entries. But here's the key, is I want those areas to be inside of favorable large triggers. I want those areas to be nestled inside of large and synthetic triggers, and I'm going to show you my picture of favorable large triggers. And we're going to talk about the difference between favorable large triggers and triggers that aren't so favorable. So on your small chart, you have two large triggers. You have the large trigger, which is native to the small chart. And that native large trigger is smooth, doesn't have any steps on it, pretty easy to recognize. And then it also has synthetic triggers, and these kind of have steps on them. And all the synthetic triggers are the large triggers from the large chart. So when they are one on top of the other, these triggers are a correction point for price. They're moving averages. We anticipate price to come back to these areas. The tighter they are one on top of the other, the smaller the correction point becomes. And then even more so, the tighter the areas are one on top of the other inside of favorable large triggers, the smallest possible window of opportunity, the smallest point where the market is likely to continue is created. And I did this little thing, guys. I'm going to start a blog, I think. I'm going to share this with you guys on favorable large triggers. And I'm going to start piecing these things out, guys. And one of the things that what we do gives us such an advantage is we can pinpoint where the market is likely to continue. And I want you to see this picture. When you have favorable large triggers, entries become very precise. They become very low risk. When your triggers begin to separate and split, that correction point also separates and splits. So your window of opportunity becomes even larger. The area where the market is most likely to continue grows exponentially. And when that happens, you increase risk. And when that happens, you have the potential to reduce profit potential. So we're going to keep it very focused. When the large chart is screaming to the upside, we're going to wait for a little pullback right at Fibonacci support inside of favorable large triggers. So much so that we're going to buy it while it's on the way down. And this is going to allow us to increase our profit potential. It's going to allow us to reduce our risk. And when everything says down and the path is clear and the momentum is strong, you guys are going to be able to sell high at Fibonacci resistance. You're going to be able to pinpoint where the market is most likely to continue. And you're going to be able to do that because of the refinement process that the small chart offers. I put a black bar or a black box around one bar. The bottom of the most current bar is where the pullback is going to begin. That tail or that wick at the top of the exact same bar is hopefully resistance inside of favorable large triggers. And guys, there was 10 bars to get up there. And there were another 10 or 12 bars to get back down before the next bar forms. And there's fluctuations inside of that bar. It's like an X-ray. And we use this X-ray, we use this refinement process to define our area for entry. Guys, you are going to be so precise. I watch people get their entries to the tick all the time, but everything starts with the large chart rules being met. And guys, this little sequence that I'm going to show you is in the spreadsheet that I shared with you. A termination that creates a reversal, a no triggers through termination that reverses the market, is what we call a strong bottom. And a strong bottom is the precursor for the highest probability trend trade you can take. My most current bar lets me know that I have odds favorable momentum, and my most current bar has not reached Fibonacci resistance. Both rules 1 and 2 have been met on the large chart, guys. So I'm going to turn my attention to the smaller, faster chart. And all I'm going to do right now is just kind of look. I want to see where the triggers are. I want to see what sort of areas are on it. But I have to wait for the small crowd to do their thing, guys, and that begins with a reversal bar. So the first thing that I want to tell you is that your entry is not the reversal bar. The reversal bar signals the beginning of a pullback. The pullback should get us to areas inside of favorable large triggers. But what this reversal bar does for you is it says, hey, let's look for those trigger lines. Are they wide? Are they angled in the direction of the trend? Are they one on top of the other? Are they what we would consider favorable? And then once I see my trigger lines, I have to find the areas within. And I'm looking for fibs, midbands, yellow 1-to-1s. Remember, the triggers are where I expect the market to correct, but I want to give it something solid to bounce off of. I want to give it a brick wall to toss this tennis ball against. So I go from the trigger lines and I refine it down from the highest point of support to the lowest point of support inside of favorable large triggers. And this becomes my window of opportunity. This becomes the point where the market is most likely to continue. And you can see that it's not to the tick. This one's a pretty big range. But this is exactly where, with odds favorable momentum, with a clear path, with a little shove by the small crowd, this is where I'm expecting the market to bounce, to continue with that momentum, to continue with that trend. So what I'm going to do is I'm going to activate a limit order. I'm going to right click a couple ticks above that highest point of support, and I'm going to wait for the small crowd to do their thing. And if they're able, then I'm going to be in a long trade. But I'll be in that long trade with the advantage of momentum, with a clear path, with an entry area. And I'm in a trade that typically wins 70 to 80% of the time. And I'm in a trade that's creating confidence through the memory of success. And even when the market's going down, the rules don't change. They just reverse. They go upside down. Strong triggers, clear path, wait for the reversal bar. Once you get a reversal bar, find your triggers. But that's not your entry. Your entry comes from areas inside of those favorable large triggers. And once you define that window, you know where the market is likely to continue. You're going to activate your limit order. That's what the yellow line represents. Notice that there's no tails on the large chart. But if the market is able, if the small crowd is able to push up, well, now you're in that trade. You're in that short trade with odds favorable, with momentum, with a clear path. And guys, this is your highest probability trend trade. This is the trade that if you commit about 20 days to just finding that window, trusting it, getting in at it, not worrying about results, but rather execution, guys, this is the one that makes you a chart reader. This is the one that has you understanding when the market has momentum, when your path is clear, finding that best of the best entry. And guys, if the triggers are a correction point, Anything beyond the triggers is beyond where the market should have gone. We don't expect it to get beyond these areas inside. And that's one of the advantages that understanding how to pinpoint where the market is likely to continue gives us. Because when you know where it's likely to continue, you also know where it shouldn't go. I don't know. Show me a picture, Josh. That's always easier. Take a picture of it. Show me both charts. Let's go through the rules together with it. And we'll do it together. Guys, once I get into the area, my stop goes where the market shouldn't, typically 4 or 5 ticks above that window of opportunity. This is why it's so important that you understand the window of opportunity. Once I get a reversal bar, I can minimize risk a tick or two above, guys. And if you just focus on the best entries, it creates low risk scenarios. It creates higher probabilities for success. And let's go to crude oil and let's see what happened. Let me shut everything down. Oh my gosh, my NinjaTrader crashed. Guys, if you draw on NinjaTrader too much and scale around and don't ever get rid of anything, bad things happen. So I'm going to pull it back up real quick, Josh, and then we'll take a look at it too. We'll go through the 2 charts. You got the picture because I think this probably sets up the window, right? So odds favorable in a clear path, and this is beautiful. And that mid band is right at the top. And guys, I'm not going to split hairs over a tick or two. It's because it's a tick outside, right? It's out by a tick. Yeah, because I see this a lot. And I see people skip the trade. And guys, let's do this. And Josh, I think that this is absolutely beautiful. And if we just annotate, and we don't need that chart, right? Let's do this. If I have the best trigger look ever, and I have a clear path, and there's nothing in the way, and there is one line right there at the top of the triggers, and it's literally by the time it starts to go down, it's inside of the triggers, man, I'm cool with this, right? I'm okay with that. Because this chart is so pretty, I love this one. Now, this line up here, 6, 7 ticks beyond those synthetics, beyond those trigger lines, guys, that's not my spot. That's not what I'm looking for. So if you're a tick beyond, let's not talk ourselves out of the perfect look, right? And even more so, if you're a tick below, your risk may be a little bigger, because it may go to the top, right? But a tick below doesn't scare me because it's before the correction point, and I just have to realize that I may have a little more risk on there. So Josh, I like it. And let's look at it. And this is what it looks like live, guys. Termination reverses the market, and then it creates odds favorable, small below the large are wide, and the small crowd is screaming down. You guys wait for a reversal bar, and at the time of the reversal bar, it's a little bit beyond. And Josh, if you missed this one because it was a little bit beyond, that's okay, right? But look how the mid band comes down as price pulls up. And the closer price gets, the closer the mid band gets. And now we're talking about 1 tick, literally 1 tick difference. So if you decide to get in at the 1 tick difference, is it safe to say, well then if it goes up here to 95, 5 ticks beyond it, I've got 5 ticks of risk on this trade. And the cool thing is once that reversal bar happens, I've got 2 to 3 ticks on that trade. But guys, this is one of those things. If you're a brand new user, it's okay to not take this trade because it's a tick beyond. It's okay. But I'm going to tell you right now that just a couple weeks of chart reads, you'll never miss that trade because the large chart gave you the best look you could ever hope for. And it becomes this opportunity for you to be okay, for you to say, yeah, you know what, it's worth the risk. My chart read says that it's worth the risk. So are there any questions about a high probability trend trade? Guys, I try to keep it so simple in the beginning. Let the large chart lead the way. Let the large chart tell you that there's momentum. Let the large chart tell you that the path is clear. And then look for entries on a small chart. If you look for entries on a small chart when the rules aren't met on the large chart, the likelihood of you getting run over goes up exponentially. It really does. Because the large chart needs to lead the way. And what's cool, and I told you guys I was going to give you a solid trading plan. I'm going to do that right now. One of the most profound things ever said to me by a trader was, Mark, if you don't have a written plan, you don't have a plan. If you don't know exactly what it's going to take you to get you into the market, how are you going to be able to repeat the pattern that brings you success? And as soon as you try to trade without understanding what you're looking for, you leave yourself open to emotion. You leave yourself open to opinion, and hope and wishing and wanting. It all comes into play. And my father-in-law was a pretty smart guy. He told me once, he goes, Mark, he goes, wish in one hand and poop in the other. Tell me which one fills up first. And that sticks with me with trading. So I'm going to give you guys a plan as the new user. I'm going to give you a plan that is a stepping stone in your journey. This is not the end of the road for any of you. It could be, and you could really be very successful with this. I see it all the time. But this one is designed to optimize your chances of success with the high probability trend trade. And it's also designed to take into play your first medium probability trade. And I didn't talk about it when we did termination conditions. But for you guys, we talked about it's either broken or it's not. It's either a termination or a clear path. The reality is you're going to get to this point where you're going to begin to recognize what's called a 50-50 look, and where 50% of your trigger lines smash. And I mean smash through an area, 2 to 3 points. But the large triggers haven't made it yet. Guys, this is what we call a 50-50 look. 50% of your triggers are through, 50% are not. It has nothing to do with your chances of success. But what it means with odds favorable momentum, and that's the key to this look, that this area has the potential to break. But it's not broken yet, which means that it's not a clear path, which means that if you go back to your little advantages here and you look at the 3 things that make a trade, momentum, a clear path, and an entry area, well, then you realize that without a clear path, you're 33% down, which means that this KISS plan, this highest chance of success plan, is going to have you focused on not forfeiting momentum and not giving up the perfect entry area. And that's going to be your first medium probability trade. So this is designed to optimize your chances of success with the high probability trend trade and the 50-50 trade. And through simulation, study, class feedback, continuous practice, you're going to create a plan that's tailored to your personal goals based on your experience reading the indicators. What does that mean? That means that when you start to recognize patterns, you may find a pattern that suits you better than the high probability trend trade. But if you don't learn how to read your indicators, the likelihood of you recognizing these patterns goes down. And your plan is going to be based on your ability to read the indicators. The high probability trade teaches you to read your indicators. That's the only reason that we spend an hour on this every morning, is so that you can become a chart reader. And the simple plan for consistency: never fight the large chart. It seems like it's intuitive, right? If the large chart says up, go up. And if the large chart says strength, don't fight the strength. But you'd be surprised at how many people do. And the idea of not fighting the large chart prompted my brother to write this book, How to Commit Financial Suicide in One Easy Step. And chapter 1 is the warning signs that your friends are in trouble, is that they're trading against strong triggers, guys. When you fight momentum that's being established on the large chart, your survival rate goes down a lot. And I'm going to tell you that you'll get to a point where you begin to recognize patterns that you can do that. But as a new user, you just don't have the reps to make that decision yet. So it's safer to not fight them. And the second one, and one of the biggest mistakes that new users make, is trading into termination conditions, trading into areas that may reverse the market, that may stop the market, that may create untradeable bounces. And guys, this is one of the reasons why I ask you every day, please tell me your read. Tell me what you saw. Because if you identify a clear path, but it's 50-50, then you're robbing yourself of the ability to know how to manage that trade. And if you tell me that you have a clear path, but it's actually a termination condition, then you're robbing yourself of that advantage. So we'll have a conversation and we'll backpedal and we'll talk about these advantages and we'll look at pictures and I'll teach you how to study them. So please, please, please tell me what you're reading so that if there is a challenge, we can correct it. And define your entry, not my entry. My entries are not your entries. You and I are at different spots in our chart reading. Gary's entries are probably not your entries. Haji's entries are probably not your entries. You have to own it. You have to make the plan yours. This is what it takes to get me in the market. Strong top or bottom, strong triggers, no terminations, area for entry. And guys, I've never had anybody use this checklist and do worse than 70% ever in the history of the checklist. So I'm going to give you a version to put on your desktop. Print this out. Police yourself. Write these rules on your chart. Talk to yourself in terms of advantages. And then I'm also going to give you, for you guys that are visual readers or visual learners, the exact same checklist, but with pictures of what it means to have a termination that reverses the market and what it means to have strong triggers, and maybe even more importantly, what it means to have weak anything can happen triggers. How to identify a termination condition, how to understand when the path is clear, and also how to understand when the potential is there for that area to break. And then finally, your window of opportunity from the point of reversal to entry, and even where your stop should go, where your limit order should go. Guys, this is as solid a plan as you will ever get for the new user, and the result is going to be your ability to read charts. But every solid entry has to be managed, guys. Every time you take a trade, you have to do something with it. You don't just get to walk off and go make a sandwich. So the way that your entries are very mechanical, the way your entries are very focused, very, very advantage-centric, is that a word? You should allow, as a brand new user, your management to be just as, if not more, mechanical. 100% if-then based. And there's that magic phrase again, guys. You're going to create a plan tailored to your goals based on your ability to read the indicators. So the first thing that you have to do, advantageous. I love that word. It just flows. The first thing that you have to do, and probably the most important thing for anybody in this room, is to be able to recognize where the market is likely to continue, to be able to take an entry. Come on, pictures. At the area inside of favorable large triggers. Screencast is taking a second. Let me see if my other screencasts are... Uh-oh. Bob? Guys, it looks like screencast is down for a second. Dagnabbit. That's okay. We'll do our own management plan. So your management plan is based on your ability to take the perfect entry. Let me go back to 6:30. This is the S&P. So we're going to take a picture. 10 a.m. news. Thanks, Cav. And this is in the KISS plan. This is the management for the KISS plan. Once I get the reversal bar and I create a window of opportunity, and guys, I want you to see this. My window of opportunity goes from this fib to this midband. That's the most important thing. Can you guys give me a why if you're comfortable with this concept? Your plan is based on your ability to understand where the market is likely to continue. And then once you know where it's likely to continue, you know where your stop should go, where that market shouldn't go. So in the beginning, this is it, guys. That's the whole extent of it. Is your stop goes outside of the window of opportunity, 4 to 5 ticks, and it's either going to get hit, and that's okay because anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. Anything that wins 70% of the time loses 30% of the time. But here's the cool thing, is with all of those advantages, if that market gives you a reversal bar in the direction of the trade, you can reduce your risk 2 ticks above it. And that's it. You're either going to get stopped out or the market's going to go down to your first target, guys. Your first target is $100. That's it. $100. Because with all of those advantages, with odds favorable momentum, with a clear path, why is that even on there? With the perfect entry, $100 isn't hard to reach. And once you reach it, you're going to go break even. You're going to have $100 in your pocket and you're going to have zero risk on the trade. And that's done to give you the confidence to stay in that trade to hold for $200. And guys, if it goes down to your second target, you're out, you're done, that's it. And you just made $300. And you made $300 with every advantage. And if that's the best you can do every day, it's a $1,500 week. And guys, that's a $6,000 month, and that's a $72,000 year based on the most mechanical, methodical approach to trading that you're ever going to see. And the cool thing is you can go back and you can test this. And you can say, hey, look, I've got odds favorable and everything is down and it's coming from a great spot. And if I circle that tail, it pulls right back to resistance inside of favorable large triggers. And this is my pattern. And let me take a picture and let me drop that in the room and let me ask Mark if I'm reading it correctly. And this is my odds favorable momentum, but I don't have a clear path. The smalls are above, the large are below. Rule number 2 isn't met, which means that I'm looking over here to make sure that I don't give up momentum through divergence. And I really wanted this to come from a termination that reversed the market. And because it didn't, there's a chance that they may try to get to that next fib. It's hard to tell in a really strong trending market. So we rely on our rules. We rely on that very pragmatic approach to get us in, to get us out, to give us advantages, to keep us focused, to become chart readers. And guys, if you break this down and you get rid of all of the wording designed to help you guys here in the classroom, this plan is approximately half a sheet of paper with big bold type. It's not extensive. It's not confusing, I don't think. In the beginning, it takes a lot to understand. But if you break it down into the individual concepts, and this is where the 101 section comes in play for you guys. And I think this is my, I'm going to pat myself on the back moment. Because if you do this exercise, let me get to my 101 class real quick. If you do this exercise, in order to get to where you want to be, you have to be able to recognize looks and patterns quickly, guys. Not like in a week, but you have to be able to look at your charts and understand whether or not the advantages are there almost instantaneously. And the easier, it becomes easier the more you look at it. So this is going to reinforce the lessons. This will speed up the process of becoming a chart reader. And I'm going to tell you right now, 99% of you in this room won't do this because it feels like work. 99% of you are going to skip this step because you don't want to take the time to take pictures of strong triggers. But if you take 25 pictures of strong triggers, guys, you're never going to have any doubts about what strength looks like. You're never going to have any doubts about what momentum looks like. And then you're going to reinforce the lesson by taking pictures of weak triggers. And not only are you going to take pictures of weak triggers, but you're also going to see the reaction of the market. You're going to take pictures of a clear path and pictures of termination conditions, and then take pictures of that 50-50 look. And I'm telling you right now, this is, let's see, 125, 45. This is 165 pictures. After 165 pictures, guys, putting them into your spreadsheet, and I click on strong triggers, and I'm never going to miss this look, right? And if I click on strong triggers again, taken from a different market at a different time frame, it looks exactly the same. And if I click on strong triggers again, once again, different market, different time frames, there's never any doubt in my mind what it means to be trading without strength, or what it means to be trading with strength. And then when weak triggers, the exact same thing. And look at the retracement off of the weak triggers. Anything can happen. And guys, I won't make you do it. I won't ask you to show me your spreadsheets, but I'm going to tell you right now from experience that if you do this drill, you will be a better chart reader. If you do this drill, your recognition of your rules met and your advantages will happen faster. And the task isn't just to take pictures, guys. Annotate your charts with the Ys. Why is it strong triggers? Because the smalls are separated from the large. What is the advantage of recognizing termination conditions? What's the formula for a termination condition, right? Don't just put, hey, this is a termination condition. When you do it, write on your chart, these are all termination conditions because price reached an area and the triggers remained above support and below resistance. No clear path. You're reinforcing the idea that when price reaches one of these areas, even with odds favorable momentum, your advantage is gone and you don't have to hope or wish or want. You can simply speak to yourself in terms of advantages. So if you want, you don't have to do this. But go through this for each picture, guys. And what you're going to do is you're going to be able to take these 3 looks and piece them together to create a trade. And then you can go back and you can study this trade. Let me show you the picture to help you study. Hold on. Hold on. Almost there. You can go back on the large chart, and when the rules are met, circle a tail. And if that tail lines up with support or resistance inside of favorable large triggers, guess what? You have a high probability trend trade. Go take 100 pictures of the two together. And you'll never miss it when the market is live. Go take pictures of it, and you'll never miss it when the market is live. This is weak triggers with divergence. The mid-band is the first correction point. That's where we expect it to go. If you went long on a 50-50 with divergence, who got run over on this S&P trade? If you did, you should post a room. We've got some great lessons for you. Here I have a termination that reversed the market. It gave me momentum. And it pulled back 1 tick above support inside of favorable large triggers, and now the market seems to be going up. And those are the only charts that I have open. So guys, are there any questions about the high probability trend trade? What do you think? Should we take a late entry, buy the market? Looks like I'm about to crash my software again. Yep, I'm moving charts too much, guys. I apologize for that. So what I'm going to do is I'm going to take 5 minutes. I'm going to go stretch my legs and breathe through my eyelids, and I'm going to go pet my dog, and then I'm going to come back. And when I come back, what we're going to do is we're going to look at the pictures that you guys have posted. And I'm going to go through them in order. And we're going to talk about advantages, and we're going to look at your entries, and we're going to look at your exits. And guys, it's imperative that you tell me why you did what you did if you want to get the best feedback. And I'm going to tell you right now, every time you post in the room, it's the equivalent of a private session. It's you and I having a conversation about what you saw, what you felt, what you thought, where you entered, where you exited. And this private session isn't designed to boost or deflate your ego. This private session is designed 100% to make sure that you're reading your indicators properly, guys. That's my job. So really the magic of what we do and the key to what we do revolves 100% around your participation. And you have to minimize your learning curve, you have to post in the room, win, lose, or draw. And guys, I'm going to tell you right now, don't worry about what anyone else thinks. If you post in this room, that's your chart, that's your trading, that's your win, that's your loss. Don't worry about what anyone else thinks, guys. Their opinion should mean absolutely nothing to you in regards to trading. because trading is a solo sport. I don't want you to hold back losers because you're afraid that it's going to look silly. And I don't want you to hold back winners because you don't want to quote unquote show off. It's only showing off if you post in the room and you don't tell me why you did what you did. So if you're telling me why you did what you did and you keep winning, man, we're going to celebrate. We're going to high five. And if you find yourself getting butt hurt because you're not taking winners as much as somebody else, work through that shit. Study a little harder. Stick to your rules a little more, and eventually you'll be the one posting those winners. So let it be a fuel to move forward. But you got to post in the class, guys. Every trade, win, lose, or draw. And if you win and the rules are wrong, you may have a short-term victory, but a long-term failure. How are you going to know the difference? To be sure, you need feedback. We're here to help. If you place a trade on the simulator, if you participate in class, there's no risk of loss or capital. You need someone to tell you what you did right or wrong when you're new. That's it. That's what we do. Every day, 15 hours, every week. All we do is talk to you about how to do it better. So give me that opportunity. You can't open NinjaTrader at all. Get with Jason, Rob. I'm not sure how to fix that from where I'm sitting. Mine did too. I don't know. Maybe it's going around. So if you can't open it at all, Rob, best thing to do is get with Jason and let him help you out. Sometimes if I'm ever having big NinjaTrader problems, I just reinstall it. I repair it. So there's NinjaTrader install. You can click on that and download it and just hit the repair button and go through it with NinjaTrader closed. Maybe that'll help. But for me personally, Jason is an absolute genius. And I like to give him the opportunity to help out because he does everything 1,000 times faster than I do. So I'm going to leave you guys with crude oil. I'm going to go take a break. When I come back, we're going to talk about everything that you guys have been doing. So post them if you got them. Ask your questions. I'll see you guys in 5. Holy shit. Sorry guys, I walked away and it went away. So let's do this real quick together, guys. This is straight from Software User Guide, NinjaTrader 8 Best Practices. I'm going to go to my Documents folder and I'm going to double click on NinjaTrader 8 and it's going to pull up all the files within there. If you're struggling a little bit, go to your database folder. You should do this every morning, guys. Click on your cache and your tick. Whoops. Cache and tick and get rid of it. And let it start fresh every morning. Then I'm going to go back to NinjaTrader 8 and I'm going to go to my temp folder. And I'm going to get rid of everything in there. And I'm going to get rid of all the temporary files. And then I'm going to go to my workspaces and I'm going to get rid of my recovery folder. And then if you want to, you can get rid of your workspaces folder as well. And then I'm going to close this out and I'm going to pull up NinjaTrader. So what it's going to do is it's going to come back up and it's going to come up with fresh data. And it's going to come up without the recovery workspace. And what that typically does is it fixes a lot of what ails you with NinjaTrader. So it's coming up right now, and hopefully this is enough to get us where we need to be. And my gold is the default for some reason. I don't know why. So we'll get gold up, and we'll let that load up. And while that's doing it, I'm going to scroll up to the top and we're going to start looking at the charts that you guys have posted. And one of the things, guys, is that if you are doing market replay late at night, right? Paul W. gave us this one last night. And what he did is he said, hey, Mark, I'm getting smarter. And I know class isn't. But what I'm going to do is I'm going to go ahead and drop this in the room and we're going to talk about it a little bit. And Paul, you've obviously been with us for a while. I see the MACDs. And I don't know if you know this, Paul, is you don't really need those anymore. The MACDs are written into the background now. All of these calculations, maybe that you're accustomed to doing, the software does for you, which I thought was pretty cool. But let's look at it. 13.2 triggers are strong and they're up, and the smalls are above the area, but the large are not, which means that I have a 50-50 look on this fib. Smalls above, large or not. Let me see if I can make this a little bigger for you guys. That did everything but the actual screen. Over here, you take a pullback to an area of support right inside of the triggers, and you're able to capitalize all the way up. And then, Paul, this is a beautiful trend trade. This is everything that we look for. This is strong triggers. This is well-defined area. This is honestly a beautiful trade. And this is the one that you should steal this picture and you should come back and you should look at it over and over and make sure that you can do it. And then TLC said he wasn't able to attend class. 1:49 a.m. Goodness gracious. So let's go through and let's look at what TLC did and see what we have going on. And it starts with an uptrend. And it starts with momentum, and this is that 50-50 look. And then TLC takes a trade that revolves around nothing but momentum. He says with this much strength on the large chart, with this much strength on the small chart, I'm going to get in 4 contracts once I get above the trouble, and I'm going to get out. Because the reality is it's a momentum trade. And he does it beautifully. And guys, here is one of the most amazing things about Nexgen, and I get excited about this when I see these trades, is TLC says with all of this momentum, I'm not going to get greedy. I'm going to rock it out up to here because momentum trades eventually typically turn into trend trades. So now he's got a 50-50 trade, and there's no divergence, and there's a tight little window, and he takes the perfect entry, and he gets out before the trouble spot because it's not a clear path. And TLC, I hope you're watching this later because this is beautiful trading. And then at the bottom end of it, you wrote in there, I'm having trouble knowing where to put a stop after taking the first profit. So, guys, one of the things that you have to know before you get into the market to really be consistent is the first thing is you have to know where and why to enter. And these are your entry rules, right? This is odds favorable. This is the clear path. This is all that good stuff. But just as importantly, and this is the part that takes some time, which is why being real methodical in the beginning is good, you have to have a plan for exit. And guys, this is very dependent on what type of trade, right? So for TLC, entering on a momentum style trade, a loss of momentum makes sense for an exit. And I see that you took an exit there. Looks like you took all of your exits there, right? So he said loss of momentum. And then TLC, that is your best momentum trade. It pulled right back to the area we expect to hold. Everything's still set up. The momentum was still the strongest. This is nerves. There's no reason to lock in 2 ticks yet. The trade hasn't lost momentum. Everything is still screaming. So you have to know, you have to have an exit, not an arbitrary stop move. And then when you get in for the trend trade, we know that the easiest one is stop where the market shouldn't go. Once you get a reversal bar, you reduce risk even further. Because it's a 50-50 trade, the 50-50 rules from the KISS plan say first profits at the first trouble spot or $100, whichever you want. And then at that point, you go break even. And then you wait for a reason to exit. Divergence on a 50-50 is a reason to exit. So your second exit is right here. But the reality is, guys, is you've got to be willing to leave a little bit out there for the most pragmatic approach. Other people, TLC, guys, I try to go real in depth when we do it, is when you take your first exit, go to break even. When you break above the trouble spot, if you really don't want to give any back, put it right at the trouble spot. Worst case scenario, you exit at the trouble spot, right? And if it runs, great. And if it doesn't, who cares? You just made great money. But guys, you have to know what you're getting into to know how to manage it. You have to know if it's a momentum trade, if it's a 50-50 trade. You have to know if it's a high probability trend trade. You have to understand the advantages are in place so that you can recognize when disadvantages show up, right? So one divergence on a 50-50 from a bad bottom, guys, that's a deal breaker, which means there's nothing for you to do until the divergence prints. Just enjoy it running in the direction of your trade. And that's going to be one of the hardest things that you guys ever do is watch your P&L go against you a little bit. Watch your P&L come down 2, 3, 4, 5, 10 ticks. And if you're going off of adrenaline or opinion or hope, you're probably going to make bad decisions with your stop placement because you have to put it where the market shouldn't go. And putting your stop right here, you're just chumming. You're chumming the waters. You're saying, hey, come grab my stop and then just keep going up. And I see it all the time. So keep it pretty focused initially. All right, snake triggers 8 range. I don't know what that means. Let's look and see. From above them to below them, and those are up, these are down. Snake triggers. I've never heard that before, Paul. I like that. TV antenna bar long. So you're using the old long signal antenna bar. I'm trying to see where you entered. I can't see your entries, and I'm not sure where you actually got in. 13-2 triggers, not strong. And separated, managed close, placed order long, did not fill, did not chase. Strategy, if filled. Man, that's dangerous. If filled, life could have been great, right? But you've got smalls below the large, the trend is down, no areas to trade from. You're just kind of hoping that the market goes up. And Paul, one of the things is if your rules aren't met, the 8 range, this is your confirmation chart, right? So you don't have odds favorable. You don't have odds favorable. You don't have odds favorable. You don't have areas to trade from. You're hoping that for some reason these trigger lines continue the market, right? And they did go below it, probably enough to take you out if you got into the top of them. And Paul, this becomes one of those instances. Snake triggers, you have said. I say snakes piggyback, one on top of the other. Snakes piggyback. So I want you to see, and guys, this is aggravating. For a high probability trend trade, rule number 1, not met. Rule 2, man, that's a tough call because your smalls haven't even gotten above the 1-to-1. So rule 2, iffy at best. Rule 3, no areas for entry, right? But what's the horizontal line? What is the horizontal line? That's what I'm asking. Is what made you decide that with the smalls in a downtrend, with the smalls on the wrong side, and I'm not saying that it's not a trade, right? And again, snake triggers, I'm not sure what they are. All I see is smalls inside of the large. They're pointed up. But momentum comes from a separation, right? And momentum comes from the smalls on the correct side of the large. So I'm not saying that it's not a trade, Paul, but I don't understand without momentum, without an area. I'm having trouble following the logic on the entry. And it doesn't mean that it's not a good entry based on your plan. Awesome. So, okay, so let's go through. Got you. That makes sense. So let's do this, Paul, because this is one of those times where I think that when we begin to learn the software, is we hear a phrase and we misuse it. So when I talk about snakes riding piggyback, one on top of the other, I use it to describe entries for the high probability trend trade because I anticipate price to correct to these triggers. And the tighter they are, the smaller the correction point. But the second half that I say every day is I don't necessarily anticipate trigger lines to just stop the market. I look for areas inside of the market, right? I look for a pullback with odds favorable momentum. I look for the large chart to have odds favorable momentum. And these triggers, like two snakes riding piggyback, it gives me the smallest area where there can be lines. Does that make sense? And when we talk about it in terms of, I took a lot of pictures. Let me see if I can find one. That's the one that I wanted to see. When they're one on top of the other, there's virtually no room for lines to be inside of them. It makes that entry easy, but it doesn't create strength. Strength happens from that same look on every chart, odds favorable. And then when they're apart, we use that as to define entries on the smaller, faster chart. So what this really does is those snake triggers aren't giving you any advantage at all because it's not odds favorable momentum. It's actually anything can happen triggers coupled with smalls on the wrong side of the large. And you're just hoping that the bounce happens there. If I had odds favorable on my small chart, that's a great looking momentum trade to try to take advantage of continuation. And you've got to watch these signals because you'll see them all the time. You just had an antenna bar short in a downtrend with the smalls below the large and everything down. So if the rules aren't met, these little bar structures can get confusing. Good stuff. Okay, awesome, cool. Thank you for posting that. Guys, I try my best. I never want to be negative about anything, but if there's a chart leading reading lesson in there, I want to make sure that we get it in there. Um, Termination creates a reversal, gives me odds favorable. And then the area was right there, and we covered this one in class, and this is great. Beautiful chart read. Nice one. And then Cav, odds favorable, 50-50, one divergence. Didn't quite make your mid band. So you catch it on the way down. With every trigger line down, you're out right above the first 1-to-1s. Make a little money down there. And I like the little run here too. You're looking for that momentum style trade, and instead of catching it on the way up, you catch it on the way down. Cav, I love that look. What a beautiful look. Because it could have gone up and become a trend trade, right? Or that 50-50 could have failed with divergence and just gone up from the bad top. So you said, all right, everything says down, but let me make it prove it. And I love that. I love the way that looks. Nice job, Cav. First one is a momentum style. Notice the odds favorable. Second one just didn't get his entry. So he got in a little late with established risk, and down it goes. Nicely done. And then Bob, let's see what we have, my friend. Anything can happen, triggers, but a clear path. No areas inside of favorable. And then we still have those anything can happen. And it's, again, no areas inside. And then, Bob, this is one of those tough times where the market is in this crazy downtrend, this crazy strong downtrend. I'm not sure, TLC, why multiple devices would be problematic. Maybe they're interfering with one another. Maybe you don't have the bandwidth at the house to run multiples. It will all be recorded, though. But if I need to repeat something, feel free to post it in the room. Let me know. I appreciate that, Paul. And I'm glad to have you posting. I really do enjoy what I do. I mean, I have a great time with this. Okay, perfect. So guys, let's talk about strong trending markets because Paul, I know you've been around. No, this is Bob. Bob, I know you've been around as well. And there's just a time where the markets just keep railing, right? Just boom, truck into the downside, smashing through areas, all that stuff. One of the things that some traders will do now and then, guys, is when I am in a defined strong trending market, 30, 40 bars down, 3 to 4 areas broken, never a reversal bar on the large chart, some people will just keep selling mid bands until it doesn't work because the likelihood of you having areas inside of favorable large triggers goes down dramatically. The idea that you're not going to get the absolute best of the best. Let me pull up my crude oil. We'll take a look. But what happens is you're just in this strong trending market. And I've watched people sell or buy mid bands for like hours. And eventually it will fail. Eventually you will take a loser, and that is your okay, let's stop doing it when the triggers look like this. So Bob, you have to decide if you're okay with it. One of the things that I like is if I'm just going to arbitrarily sell mid bands floating in the middle of nowhere, I love a reversal bar for a little bit of confirmation. Because if you tried to just sell the fib, you got run over. But if you waited for a confirmation bar, then it gives you the opportunity to capitalize. And I hope that makes sense to everybody. When it's not perfect, it's okay to wait for confirmation. It's okay to insist that the market start going in the direction that it says it's most likely to go. And if you never get it, the cool thing is you never take the trade. And then Andy did not take the trade, did not take the long due to the rules not met. And sure enough, it would have run you over. Happiness, Andy, isn't it? Andy said, hey, look, my rules aren't met, and I avoided a loser. Are there two of them in here? Or is it the same one twice? It's hard for me to tell. I just want to make sure that I don't miss one. Okay, same twice, cool. I love it. 50-50 bad bottom divergence. And I even said, who got run over on this one? Guys, this is one of the most common losers ever. Is when you hope it goes up instead of following your plan. So Andy, gold star for you today, following your plan. And then Jen, resistance holds, everything rolls, triggers are strong. You enter right at the pullback to resistance inside of favorable large triggers, 245, 245. So you're in right about here, which is beautiful. Third divergence prints, and you exited on the third divergence. And even though the market still went down, you followed your plan. Gold star for you, Jen. It's hard to do, isn't it? It's hard to do. Everything about that third divergence said that it could have pushed up further, and it didn't. But you didn't worry about it. You just followed your plan. Beautiful. It's hard to do, isn't it? Especially when it cranks down. But then, Jen, maybe a little later you find an opportunity. You get to this point where you're like, wait a minute, I still see down. I see one-to-ones. I see all the triggers below it. Let me get a confirmation below the small triggers, and maybe I take that one. But great job, guys. I'm telling you, one of my favorite things to see is you guys following rules, is you guys saying, hey, I'm not worried about what could happen, what might happen. I'm not worried about what I want to have happen. My plan says that I have to exit. My plan says that I have to enter. And the reality is that sometimes your plan is going to keep you out of something that runs for $1 million, right? And sometimes your plan, more often than not, is going to keep you out of things that are going to take that money. So don't be lured in by the siren song of the one time that it doesn't work, right? Look, I'm going to trade into a termination condition with odds favorable, and I lost. And I'm going to trade into a termination condition with odds favorable, and I lost. And I'm going to trade into a termination condition with odds favorable, and I lost. That's 3 in a row, right? But you guys want to know what the truth is? Is that a lot of you will take it into an area and it'll win one time, and you'll remember that. And you'll be like, oh my gosh, I have to trade into every termination condition now. Because remember the one time where I got paid? Or Jen's like, remember the one time when 3 divergences didn't reverse the market and it went down? I'm going to hold through all 3 divergences forever now. And that's what you've got to go through in your brain. When price reaches a divergence high, trades above, back below, it says everywhere, don't take the long trade. Andy didn't catch either of these and he wanted to get paid. But I have odds favorable momentum, right? But Mark, I had an area inside of favorable large triggers, but I didn't have a clear path. And the sad thing is on this one, Andy, is if you said to yourself with this much momentum and beyond the fibs, if you just would have taken it right at the mid band, you would have had 2 to 3 ticks of risk, right? And you would have been able to make it, if you would have been in at 93.3, you would have been up $100 and break even. So there's times where it's appropriate to trade into areas with all that momentum and the perfect entry and the low risk and all that stuff. But if you break rule number 2 and then flub rule number 3, there's no time to manage. And that second lower divergence, you should have been out right there, right? That loss could have been a lot smaller, Andy. But the cool thing is that you know exactly what you did, don't you? You know the mistake you made. You know what went wrong, which means that you're not arbitrarily taking trades and hoping for the best. You're still making mistakes, because we all do, but you're not saying, Mark, what happened with this trade? You're saying, oh, shoot, dang. That was a termination condition. I didn't really process it fast enough, but I will process it fast enough next time, because you're going to go back and watch this. If I just go back Support holds, mid-band with the triggers down holds. Support holds, resistance holds, resistance holds. Support holds, support holds, support holds. Resistance holds, support holds, support holds. I mean, how many times do you have to go back and watch the market bounce off these lines until you stop trading into them? And that's the one question that everybody has to ask themselves. How many times do you get punched in the nose until you stop mouthing off to the big guy, right? And Andy, you're showing progress every day. And guys, I'm going to tell you right now, there's times where I form opinions and trade into termination conditions. And there's times where I form opinions and I trade without the best momentum. And there's times where I form opinions and I don't have the perfect entry, or maybe I fight triggers. And I typically lose. And I need that loser. I need that little kick in the clackers to keep me from doing it again. And eventually you hate losing so much that you stop breaking rules. And then Andy, price didn't reach support. No divergence on the large chart. Sold when double divergence printed there. You bought with all the momentum and took it up to the problem area. So you took a shot on a 50-50 with two divergences with the area inside of favorable large triggers. This is not you. Who is this? Am I getting the wrong person? This is Jen. There we go. Okay. Sorry, Jen. I should have known bought here, sold there. All right, Jen. So I had a professor when I went to the University of Houston, and when you're an English lit major, they try to prepare you for it. This is the same guy that wrote, "Would you like fries with that?" on the board. So he was kind of direct. Price did not reach support. No divergence on the large chart. So his question, and I love this question. What does that mean to you, Jen? If price didn't reach support, weak triggers, no divergence, is there something in your head that says, because of this look, this is my expectation? Double divergence doesn't mean anything on a small chart. That means exit if you were short. That's it. That's all that means. Three divergences in the same price range may turn the trend. So check this out. 1, 2, 3. That's okay. So let me tell you my expectations. Is when I have weak triggers, my first target is always the mid-band. And you clear the mid-band, right? And then you trade into these yellow 1-to-1s. But you do have a lot of momentum. I like that. But do you see how this is barely a 50-50 trade? So my so what is that this becomes my first target. This becomes my second target. So when I get into this 50-50 trade, one divergence on a 50-50 from a bad bottom is a lower probability trade. Two divergences, especially a second lower divergence on a 50-50 trade, is even a lower probability. And it's interesting because two divergences up makes you look for the long, but two divergences down doesn't keep you out of the long into trouble. And this is the human psyche playing games with you. Two divergences up makes you feel like, hell yeah, this thing's going up. But you don't have the same expectation here. Why? Because you want to go long. Does that make sense? Oh, and I hate it when I do this, when I go back and look at my own charts. And I'm like, okay, Mark, you didn't trade into this termination condition because you were anticipating XYZ, but you did trade into this termination condition because, man, you couldn't wait for it to go up. And then it's even interesting up here because double divergence tells you to exit the trade here, and it sets you up for the long here, but you're willing to completely ignore it right here. And then let's go and celebrate a little bit too. I have odds favorable momentum. That market is screaming to the upside, right, Jen? And the smalls are breaking through. Actually, it's a termination, but that's your momentum look. And I know how much you love momentum. And I tell people all the time, momentum will help cover mistakes, guys. We're not just going to talk about the little psychology. We're going to talk about the positives too. Jen, you have odds freaking favorable momentum once again. And you have one line inside of favorable large triggers where that market may continue with this level of momentum, which means that you can enter with virtually no risk, which means that once it starts to move, you can be break even and see if this momentum works, right? So Jen, what you did is you took a calculated risk based on what the market was telling you, what your indicators were telling you. Does that make sense? So can we get to the other side of it too? Did you get lucky? Or did you say, with the strength, with the momentum, with the low risk entry, with the odds favorable momentum, there's a pretty good chance this bad boy is going to continue up. That's a hard freight train to stop. And you took your shot, and it's a beautiful shot. And your exit's freaking rock star, right? But I want you guys to notice these things, and I do this a lot, and I know that it aggravates some of you. Well, Mark, if it won, why are you even talking about the other stuff? Because I want you to win more than you lose. Because I want you to catch the best of the best. Because I want you to get to this point where everything is a chart read and nothing is an opinion. And Nexgen Ben just said it. Forget about what you think. Listen to the market. Ben's been there. Who was this being all cool and stuff? Andy, was this you? This was Andy. So Andy says, with odds favorable momentum and everything screaming down and everything breaks through the fibs and pulls right back to it, Andy, you're willing to take a shot to make a little money. I like it. And then you run into, right, the momentum's going away, divergence prints, and you're not willing to lose. I love this trade, Andy. This is just capitalizing on momentum in a clear path and not getting greedy with it. Beauty. All right, Paul, let's see what we have. Guys, I get excited when new people post, or even old people that are new again post. And I'm going to learn how to read your charts with a lot more clarity. All right, so large chart says termination, full reversal, odds favorable. Small chart says no divergence, pulling back to the mid band. So Paul, two things on this one. The first one is you're in between correction points. And I hope that makes sense. And this goes back to those favorable large trigger look. So when they're tight on top of each other, life's pretty easy. No, you're great. Your post is great. It's easily, it's legible, everything. So what I run into though is once these begin to separate a little bit, Paul, the only thing that I want you to take into consideration is that your correction point is that big instead of that big. So on your particular trade, I like a mid band, right? And your large and small get through on the small chart, and it's a great look from a termination. And this is awesome. And the only thing that I tell people is if you're gonna take a trade that's floating in the middle of nowhere, right? You just have to know where the market shouldn't go. You have to be able to set your pain tolerances and understand if they make sense, right? So you might say, I'll take this short with a reversal bar because I'm not positive that the midband's going to hold. Or I'll take this short right at the midband, but I'm going to put my stop 4 or 5 ticks beyond the synthetics because if it gets to the other side of these, I don't want to be in it. And then it's just momentum city all the way down to the fib. Does that make sense, Paul? I think from a good top with the reversal, with the momentum, midband's not a bad shot with that much momentum, right? And I just want to make sure that we don't just talk about great entries, but we talk about how to manage it. And once you create expectations based on the chart read, management becomes easier. So great job on that one. All right, waiting, no clear path. I love these pictures, guys. So there's a bad bottom to weak triggers to retrace to one-to-ones, closes the gap back to the large triggers. There's that beautiful gap theory. No clear path down, two divergences, and look at your small chart. I mean, is that like 32 flavors of angst or what? Up, down, split triggers, divergence here, divergence there. There's nothing nice about this. And then, Jen, you made the decision to just say, you know what, that's ugly. Probably not my trade. Which I think is brilliant. And that's the hardest thing that you guys will ever do, is absolutely nothing when there's nothing to do. Great job, Jen. And then JW. I love this. This is the JW trade. Hey, Dr. K. So, you guys remember when I said so what on Jen's chart? JW says weak triggers starting to roll, and he points down here. So if I asked JW, so what? He would say, hey, Mark, with this look from not an area, I see more often than not a retracement to the midband. And that would be JW, so what? This is not a strong bottom, Jen. But we'll go through it. Let me finish his chart and then we'll go through it. Cool? So JW says weak bottom trigger starting to roll. And if I say JW, so what? Well, that means that the midband's my first target. And then JW also knows that fibs are a pain in the ass when all the triggers are below them. So he says, I'll tell you what, let me get a little odds favorable momentum. Let me be on the momentum phase side. And let's see if we can ride that beautiful momentum right up to the expectation. And it's not a home run, right? But it's a beautiful trade. And it's not a trade based on on high probability trend trade. It's based on chart reading. It's based on the expectation. So Jen, when I said to you, price didn't reach the area support divergence, your so what becomes the midband as my first target. Does that make sense? And once you identify that because of the pattern, then you can begin looking for moves within. Once you identify that weak triggers, not from an area, typically make it to the midband, JW is short right here and he's out at the midband, right? Once you identify weak triggers with divergence, not from the area, you can create an expectation and then you start to capitalize on those moves within. And guess what I was thinking about last night as I was sitting in my office? I started taking pictures of weak tops and weak bottoms and showing you guys that your chart reading is going to create expectations. Your chart reading is going to allow you to begin to recognize different things. And then just like JW did, wherever his went, I don't even know, you'll be able to capitalize on these things. And man, that's all we're doing is reading charts. So there's the S&P. Termination condition, trigger lines don't match, split triggers, no areas inside, wheelies. I love wheelies. I've never been any good at them though, Ben. I was the guy that would do like the 20-foot wheelie, and my buddies would come by me standing on the seat. Not a wheelie guy. I freak out about going the wrong way. So check it out. There's that pattern again, right, JW? Weak triggers, expectations, the midband. Weak pivot from nowhere, expectations, the midband. Didn't finish, expectations, the midband. Didn't finish, expectations, the midband, but when the midband breaks, you start trading the indicators. And it is. It's better with divergence. It's better with divergence, without a doubt. Because what's divergence? It's a loss of momentum. And if it's losing momentum down, isn't it easier for it to push up? And if it's losing momentum up, isn't it easier for it to push down? And guys, I say all this stuff so matter-of-factly, and I know that I do. But I do that because I've taken 10,000 pictures. I've been run over. I've been early. I've been late. I've mismanaged. But I've taken 10,000 pictures. And commitment, Ben, is hard. If you haven't seen it, commitment is hard. If you haven't studied it, commitment is hard. If you're not 100% confident on your entry, commitment is hard. Wouldn't you guys agree? But if you know, let's go back to Sunday school. If you know without question that momentum, a clear path, and an entry area is a trade that you can capitalize on to win 70 to 80% of the time, and you've studied it, and you've taken pictures, and you've gone through it, guys, you'll never miss this trade. But if you said, okay, Mark was talking about the rules, but I really want to be in a trade, you'll second guess it, you'll triple guess it, you'll quadruple guess it, and then by the time you commit to a trade, it's already gone. Termination, full reversal, 50-50, multiple divergences. That's not pretty, right? That's not the best of the best. But now it's momentum in a clear path, right? And there's an area inside of favorable large triggers. Could I activate a limit order right there and say to myself with this look, and guys, my small triggers are on the wrong side, my stop's where it shouldn't go. Can't you just do it? Can't you say this one's more likely to win than lose? And this is NASDAQ, so those small triggers may create problems. We'll find out when it gets back to it. But when I have a termination that creates a full reversal, when I have odds favorable momentum, when I have an area inside of favorable large triggers, look at that, I got a reversal bar. Now my risk is decreased dramatically. Where's $100? $21.75? $10.75 right there. But guys, this is a NASDAQ thing. Those small triggers act as support. So you have to be willing. There's a second higher divergence. And now you're out. So now I have to say, with this look, with this look, with these looks, I need a signal to re-enter. And Ben, I don't know how much you trade the NASDAQ, but when the small triggers are less than a full bar away, I refuse to take that trade. I'm just doing it in class because Adriana said that this helps her. And look at this, and it never gives me another signal after the second higher divergence. But if you guys have ever paid attention in my class, don't fight those damn small triggers. You lose more than you win. So what does the large chart say right now? It still says strength. It says this area is likely to hold, but my small chart doesn't agree. All right, TLC, so we'll go over that right now. And this was a beautiful example of it. Do you see how those small triggers behaved as support? Guys, this is the one rule. I blew out a lot of accounts learning this rule for you guys. So give me a why, NASDAQ traders. Do you see how these small triggers act as support? Guys, the rules are same on the large chart. 100%. But here's the part that everybody forgets. Your NASDAQ large chart is the large chart on any other market that you trade, guys. Whether it's crude oil, the S&P, gold, the Russell, your large chart on the NASDAQ is a 13.2. Oh, look, there's your close on the correct side of triggers. This is your small chart on the NASDAQ. Is anybody going short against that look? Hell no. Couldn't pay me to go short against that look, right? This is the S&P. Is anybody going long against that look? What do you guys think? Is there anybody, maybe some of you, a couple yahoos, but most of you are looking for shorts. Don't fight the triggers on the NASDAQ because your NASDAQ small chart is any other market large chart. So what happens is when you get to the area, let me go to my spreadsheet and TLC. This is, if you go to the client trades in the spreadsheet that I share every day, guys, there's two different NASDAQ entries. The first entry on this one, and let's make it big, when I reach my area, when I get to my area for entry, I have to look at the relationship of the small triggers You can do nothing and it doesn't cost you a penny, does it, Gino? Doesn't cost you 1 red cent to do nothing. But how much does it cost you to fight those triggers? How much does it cost you to not have momentum? Well, then take every trade, see what works. If you can't be patient, don't be patient. That's up to you. That's on you, right? So if what you've done isn't working, doesn't it make sense to try something else? Wink, wink, nudge, nudge, definition of insanity. So guys, when I get to my area, if my small triggers are less than a full bar away, what does that mean? That means that if my small triggers are below the reversal bar marker, I'm going to sit on my hands for a second. I'm going to sit on my hands and I'm going to wait for a close on the correct side of the small triggers. I'm not going to fight the immediate momentum. If I get to my area and my small triggers are above the reversal bar marker, I'm entering at the area. And guys, this is it for me on NASDAQ. Like, large chart still leads the way. Large chart says down. Large chart says clear path. But the reality is once these small triggers come up strong, if I sell the mid band, I lose. If I sell the top of the triggers, I lose. If I sold fibs, I probably lost, right? Because I don't know if it's going to stop at the fib, the mid band, the 1-to-1. But the cool thing is eventually, if it's still going to go down, the small triggers are going to roll, right? And it's going to set you back up for it. But guys, this is NASDAQ specific. If I have odds favorable, if I have a clear path, if I have an area inside of favorable large triggers, guys, all I'm doing is waiting for a pullback. Please, just give me a pullback. That's all I need. And Ben, you're absolutely right. The NASDAQ moves faster, so much faster that you have to quadruple the size of your large chart, that you've got to triple the size of your small chart. But guys, I want you to give me a why in the room. I'm losing momentum. I do have a clear path. I do have a low risk entry right at a mid band, right at the bottom of my triggers. Which means if the market pulls back right now and fills me, it's a medium probability trade, and I have to be prepared to manage because I'm forfeiting momentum at this point. Does that make sense? I still have an entry area. I still have a clear path, but my momentum isn't the best, which means that it may push lower, which means that if I do take this entry, I'm not betting the farm on it. It's not the best look anymore. It's not high probability. And that's all you're doing with your chart reading is you're trying to decide, do I have an advantage? So I'm going to take 5 minutes, guys. What market do you want to watch while I go away? Hopefully it stays up. And guys, there it is. Watch the NASDAQ. And now it's changed. Now it's not the same look. But could you imagine not taking this trade because of that one rule? How many times could you not take that trade a day and not get run over? How many times could it just be rules-based instead of opinion-based? Because it was a good-looking entry. But once it got to my small triggers, guys, I would have had to go and break even. You're short now, against momentum, everything going up. Cool. I hope it works. That's not my short. There's nothing about that that's my short. But that's okay. It doesn't have to be, right? And guys, for those of you that don't know Ben does just fine. Ben's got rules. Ben says with the large triggers a full bar away when I reach the mid band and it's not from a good bottom, that's my correction point. That's his so what. So what if I said I love it, but what I want to do is I want to wait for a close on the correct side of small triggers just to make sure that they're planning on going down. It doesn't change the fact that I'm fighting the immediate momentum. It doesn't change the fact that the small triggers are up. But what it says is to take this trade from the continuation point, they got to get me on the right side. And if they never get there, I'm never in the trade. Does that make sense? Once again, small triggers for the win, guys. I'm telling you, this is gold for me. This keeps me out of more losers than I can count. So I'm going to take 5 minutes. I'm going to go stretch my legs. I am going to do what I do for just a moment. And when I come back, the classroom belongs to you guys. We have gone through every chart picture. So I either need you guys to reload or come up with some smart stuff that you want to talk about. I'll be back in a few, and we'll finish strong today. All right, guys, here we go. Ben, sorry I put the bad juju on that one for you. All right. Andy, 50-50, divergence. And then, Paul, I got you. So, Andy, let me give you a quick heads up. One of my favorite, there's no way you could get me to go on this 50-50 looks, is divergence directly from a 1-to-1. It's not written into the KISS plan because the KISS plan says, I like it, Ben, because the KISS plan says don't do it with divergence, right? And then the KISS plan says one area not broken. And the KISS plan says have a nice entry area, not split triggers, not your window of opportunity extends from the lowest point of resistance to the highest point of resistance. And things just kept compounding here, Andy. 50-50, cool. I don't mind a 50-50. And then a 50-50 with divergence is a little problematic. 50-50 with divergence right from 1-to-1s, even more problematic. 50-50 with divergence from 1-to-1, split triggers, big window of opportunity, even more problematic. Does that make sense, Andy? We're just going down the line on that one. So when divergence prints, you see that negative number and that cyan line. So divergence printed. It's true on the third bar because there has to be a pivot and there has to be motion the other direction. That is where it started to pull back. It was true right at the fib. And then you were 7 bars deep when you entered. So divergence had been true for about 7 bars on the pullback. Does that make sense, Andy? So I'm going to do this real quick. Here's my thought process on it. If this chart isn't perfect, whether it's momentum, clear path, that's not true, right? There was a pullback there. If my large chart isn't perfect, it's okay to make the small chart be. Is that fair? No, you're okay. This is great. So as we come into this 50-50, you did have one divergence, but we're not worried about it. It's kind of in the rear view mirror. And then when this one prints, for me, that may not be a deal breaker because you identified it. Man, that's a good top, right? That's a reversal. That's great momentum. I might be willing to take this one with one divergence, Andy. But if I take it with one divergence, there's a couple things that I want to be true. And one of them is I want these triggers one on top of the other. That's where I'm going to insist on that best look. And I want my window of opportunity to be very concise, right? Like not spread out in between split triggers. And then this is a new lesson and probably a new lesson for all of you. When divergence prints from a 1-to-1, I choose to not take the trade when it's not perfect over here. If it were a clear path, I might be willing. But divergence from a 1-to-1, split triggers, and a 50-50. Do you see how when you don't do anything but talk about the chart reads, what it does is it allows you to say, wow, I'm kind of missing a lot of stuff here. So maybe, just maybe, it's okay to sit on my hands for this one. And then once again, Andy, we talk about this a lot. Not perfect, but I want to go anyway, right? Am I the only one that does that? It's not perfect, but I want to go anyway. I'll tell you what, I'll still go. but I'll insist on a reversal bar. So that's great that it did, and you should thank the one-to-ones for that outstanding lesson. Because I promise you, you've learned it now. You've definitely learned it. All right, so Paul W., divergences. I'm going to go back to and how the MACD-BBs are incorporated. And guys, this is more of a technical thing, and I'm not going to lie to you, I'm not a very techie guy. But I do understand this concept because, Paul, like you, I remember the software when you had to do this yourself. Oh, Cav, have a good one. And then, Paul, this looks like your chart, right? And you know it's old, you old timers, because it's an 8-2 chart. Essentially what happens when divergence is true, guys, I want you to see this. So the market goes up and the market goes down, right? And it creates these pivots. And I want you to see what the MACDs did down here, Paul. Lower, there's your push up. But when price goes lower, the MACDs are going higher. So there was a time where you had to do this math yourself, right, Paul? And you're like, man, is that really higher? Is it subtle? I'm not sure. Price goes lower, MACDs go higher. So you get these looks. And guys, for those of you that don't realize how spoiled you are, you had to watch this both sides, top and bottom, to do it. And then, Paul, the cool thing is you don't have to do that anymore. Because now the new stuff says, hey, Paul, check it out. There's the potential for divergence here. It won't be true until the third bar, but there's the potential for divergence. And if you go through and you look, hey, Paul, check it out. On your small chart, there's the potential for divergence to the upside. It's not true until the third one. So, Paul, you don't have to do those calculations anymore. Your chart will literally print the negative number. It'll print the line if divergence is true. I did. I'll review it again, TLC. I thought you weren't going to be here. Does that make sense, Paul? So the MACD-BBs... Adriana, you don't need it. Watch this. Adriana, what does this mean right here? Loss of momentum, right? And you can see it. You know that it's true because it's there, because the negative number there. That you will not enter. Well, that doesn't make any sense. There's not enough information there. But it means that there's a loss of momentum. It means that in the push-up, there's a loss of momentum. And with that loss of momentum, you'll have rules in place, right? On a 50-50 with a loss of momentum, maybe I don't take the trade. So Paul comes from a time where, and let me see if I can find one of Paul's charts. I'm telling you, you guys are spoiled now. Where Paul had to look at these MACDs down here and make the determination himself as to whether or not divergence was there. And now you just don't have to. The software does it for you, which is pretty cool. All right, let's get into another chart. And then, guys, anytime I don't have charts, we're gonna rock it out and have some fun. All right, Matt, welcome. It takes 3 bars for the divergence to be true. So what happens is you'll see the potential for divergence, and right here, it'll either be true or it won't. Does that make sense? Cool. So Matt, how long have you been with me? I noticed that it's black next to your name. 60 minutes. I love it. So first of all, thank you for posting on day one. That's amazing that you would post on day one. What's even more amazing is that your chart would have odds favorable momentum. And that's rule number 1. So Matt, you have the advantage of momentum coming into this trade. The one thing that you don't have is a clear path, and that's rule number 2. But I got to tell you, 60 minutes in, you picked off where the market is most likely to continue like a sniper. So every time you go through and you take a trade, you want to talk about the idea of one, where are you coming from, right? Is it a good top or a bad top? Is it a clear path or the potential to be clear? And this was the potential to be clear. And look at your entry. Right at the area of support, right inside of favorable large triggers. And then you caught the second one when the path looked even better. And did you exit at Fibonacci resistance? Beautiful. Still long? So you have weak triggers at resistance. Now you have a loss of momentum. See how it's true as the third bar comes through? So Matt, one of the great things about what we do here is not only do we know where the market is most likely to continue, and I'm going to tell you right now, you nailed it, but we also understand where the market is likely to go. We have these giant big Fibonacci lines, and we can use trigger line strength to give us an indication of whether it's likely to hold, likely to break, whether that bounce might be kind of big. And you're right, worth the shot with a good stop, Ben. When the advantages are present, absolutely. So I don't know if it's going to go up or down, Matt. I don't know if it's going to break or hold. I don't know what's going to happen here, but what I do know is that I've never been mad about getting paid at a fib. I don't know what open price is. I've never been mad about getting paid at a fib with weak triggers. And the reason I say that is because when I hit a fib with weak triggers, look at the retracement. And when I hit a fib with weak triggers, look at the retracement. And when I hit a fib with weaker triggers, look at the retracement. And what you're going to find, Matt, is that more often than not, you look like the smartest man alive if you're in a long trade and you exit at resistance with weak triggers, right? And the whole goal is to get paid. And the cool thing is, if it's going to break, it's going to break. We'll just look for an opportunity to get back in. So nice read. Trading with direction, trading with momentum, trading from the areas. And I'm going to tell you right now, it's just going to get easier every day. But what I want you to do, Matt, is I want you to not only take the picture, but I want you to write why, if you'll do that for me. I want you to write on your chart, hey, Mark, check it out. This is what I saw. This is what I was thinking, and this is where I got in. Is there any way for me to do it better? And then, Matt, you and I'll become best friends the more you post. Because we're just going to keep working together. No, you're doing great. So just put what you think. Hey, man, I don't want you to, you don't have to be right. And you were. It looked right. Why did it look right? It looked right because you had momentum, and it looked right because the area had the potential to break. And those are the parts that you'll incorporate, and that's what makes it repeatable. So nicely done. The lines. Love the lines. Man, that red one's still holding too, isn't it? So, Josh, everything says up. It didn't get to the mid-band, so you caught it on the way up. You said, dang it, it didn't get there. I'm going to get in because I've got odds favorable and a clear path. Get paid. And then the second trade, you're in early, you got scared. And it goes right to your entry point. And imagine being in at 73 and making a couple hundred at 83 before any problems happened, instead of making 40 bucks and having to sit through all that nonsense. And guys, this is what we talk about a lot, is you've got to learn to trust your entries. And the flip side is you got to be okay to not take your entries if the rules aren't met. And that's the hardest thing that you'll ever do, I promise. It really is. Josh, I did not show a picture like this and say that a lower divergent was a termination. What I did do is one day we were talking about management. And when we talked about management, If I'm in a long trade and I get a second lower divergence, for me, that's an exit condition. And the only way I'm going to get back in is if I get a signal for reentry. So second divergence for me is a management condition, get out of the trade. But if I get a signal to get back in, I don't have any qualms about taking it because it's not three divergences in the same price range. Does that make sense? And then when we go through these, once again, if you get that second divergence and you exit and you never get the reentry, just like the NASDAQ did, right? Then it keeps you from taking that next trade. And then Andy, for you, brother, take half your profits at the yellow 1-to-1s and exit if any divergence is true, which is the same thing as saying don't go long here if divergence is true from 1-to-1s. Pretty cool, right? Management's the second piece of the puzzle. Management's the one that requires you to read your indicators at a moment's notice, and that's what we're working towards right now. Beautiful, Jen. Okay. All right. I'm working on my Australian accent still there. No, but Andy, do you remember when we talked about on your chart, because we're trying to make you even more of a chart reader, divergence from the 1-to-1s is problematic. So as much as it says get the hell out, you can allow it to say don't get the heck in. Right. All right, so let's see what you have. Let me see where your entry is. 29.25, 29.25. So you are odds favorable, maybe not quite a clear path. Perfect pullback, low risk, easy money. Nobody talks like that, Jen. Come on. Learning ski in a trees. Neither is heading off a cliff. I know you do. I had a great friend in high school that was from Australia, and it was sad because Crocodile Dundee came out right about that time, and everybody would try to talk to her in an Australian accent, and it drove her nuts. So she would point to the girl from South Africa and tell them to go talk in an Australian accent to her. It's a knife. All right, Gino. The only thing you'll ever need to know about whether or not you should ever look for an entry. Anything can happen triggers, right? And you said on there it's fear of missing out, but I've got to turn this into a lesson. Guys, strong triggers break areas. Strong triggers break areas. Strong triggers have the potential to smash through areas. Weak, do nothing, can't get anything behind them. Oh my gosh, anything can happen up or down triggers. Typically don't. And then Ben says when the triggers get above and resistance becomes support, buy the pullback. And I know that it was fear of missing out, but you don't have momentum on any chart. Not enough to make you feel like the area was going to break. So let it break. And then once it breaks, look for your opportunity. Notice how it's still weak and three divergences in the same price range. So Matt, this is one of the lessons you're going to get as well. There's a second lower divergence saying, hey, Matt, it's getting bad. There's a third divergence in the same price range. It says, Matt, seriously, dude, I know you're new, but we talk about this first thing in the morning, every morning, so you don't ever hold that trade for the duration. And guys, it's freaking amazing when you can watch the live market and you can literally say to yourself, these are my rules. These are literally my rules keeping me safe or getting me into a trade and stuff like that. So Ben says robots will hunt the stops, wait for the area. So Ben, you're suggesting that these areas are so freaking good that even trade robots know where they are? And if we just avoid them, we can stay out of those problems, stay out of those fights, stay out of all that decision making? Sounds made up, Ben. Maybe your helmet's too tight. I don't know. But Ben's absolutely right. Guys, you don't have any idea how good you are and how good you're going to be. Because this is just the beginning. There it is again. No reason to hope. There it is again. No reason to hope. Hope sucks. Hope's the worst trading plan ever. It really is. So guys, we're just going to, you guys can post pictures or questions. Tell me what to talk about, but I'm just going to keep flipping through 3 markets and see if we can get our rules met somewhere, and we'll play on simulator just for the fun of it. Josh, have a good one, man. Thanks for being here. So here's one of those things where you can say to yourself, if it ends up breaking and these roll, I'll look for an opportunity. But until I get back on the right side of things, you want to see something amazing too? Watch this. I love doing this. I'm going to circle that bar. Look at all the nonsense. Let's do 2 bars. 2 bars on the large chart. An exorbitant amount of nonsense on the chart. And you're absolutely right, Ben. 3 divergences on the small. And these 3 divergences are in play until the small and the large triggers are above 74. And if they never get above 74, guys, then 3 divergences says no dice. Maybe too soon for shorts because everything is greening up. So, yeah, so it's either got to break or it's got to pull back, right, Ben? It's got to create space away from the decision-making process before I have a shot. Now I have a clear path, right? But I just don't have anywhere to go. Don't have anywhere to go. So let's play if then. If the small triggers break away from the large and get above the area has the potential to break. If that happens, then I'll hope for a pullback to an area inside of favorable large triggers. But until that happens, I'm content doing nothing. And guys, trying to chase every trade is like being mad at the kid that got the ice cream truck and you didn't because you were inside doing something else, right? You can't get mad at him. There is no we, Gino. What do your rules say? What do you need to enter a trade? I still don't have a clear path. By the time it cleared here, it was into a line. Sucks when that happens. You need an area, that's it? All right. Follow your rules. Write them on the chart. My chart read says that I'm in a strong trending market to the upside. But my chart reading says that I haven't broken the area yet because my large triggers aren't through. If that changes, if I get an up bar or two and the market comes up, so I don't have momentum, but I'm strong trending. I do have a clear path, and I do have an area inside of favorable large triggers, which means that I am 66% of advantages, guys. Which means that if I get pulled back to support that used to be resistance, and it's inside of favorable large triggers, well then maybe, just maybe, I'm in a trade. Does that make sense? And if it gets me, here, let's make it get us, oh, come back here, come on. Where shouldn't the market go? It shouldn't go below these triggers. Oh man, but without momentum, it did. Rule number 1 not met. And guys, this is what sucks. Now the smalls are below. So Gino, did I have odds favorable momentum? No. And I had a loss of momentum. And guys, this is it. This is where you get sick of waiting and you forfeit. You say, you know what? I don't need my rules anymore because I really want to be in a trade. That's a tiny little loser. Maybe, Ben. It might be from here. Because that certainly is support and all the triggers above, right? The reality is I don't know. There is no divergence yet. I don't know. But what I can do is say the only way I'll possibly go long here is if for some reason it closes on the correct side. Now I have divergence with weak triggers. Now we create the expectation. JW saying, man, clear that area. I triple dog dare you to clear that area. And JW says, to hell with your fibs. Get that price below there. Go, go, go. I'm gonna play JW's card. He says, that's good enough. Let me put some targets at the midband because that was divergence and weak triggers. And let's see what happens. And that was probably premature for JW's trade. Because all my triggers are above support, right? So it's not a high probability trend trade. This is JW recognizing a pattern, creating an expectation, saying, you know what? It's just momentum. I'll take one. And I'll put this one and hide it behind the fib. So if it does pull up, if it does come back to those triggers, I don't lose much. But let's see if it makes the expectation. JW, did I get it right for the most part there? I don't have rules for this trade, guys. So I'm hoping that I read it the way JW reads it, right? I don't know where my stop is supposed to go. I do know that all those fibs above me are termination conditions with the triggers up there. I also know that the gap theory is in effect, right? So maybe I have to manage a little more aggressively. And it just depends on what you're doing, right? It depends on what your plan says. Thought we were going higher. We didn't. Nope. And then Gino, without momentum, it becomes a little more difficult. Without momentum, it becomes a little more difficult. And that's what you have to accept, is that without momentum, it's difficult. JW is still feeling smart, right? JW is saying, man, this is my pattern. I'm in the momentum phase. So if I'm momentum in, what's momentum out? How about a close on the wrong side? So I'll put my reversal bar. Gino, how many of those 100 points do you catch? Okay. So Gino, I don't care about others. None of them are writing you a check, right? So tell me something. And guys, this is just something that you have to think about. Is what trades are easy for you? And I'm not giving the answers because I don't know what trades are easy for you. Let me put that a couple ticks above my midband. We'll see if JW is right. So we're going to do self-reflection, guys. What's my easy trade? So for Jen, it's momentum. For Debbie, it's a trend trade. For Ben, it's an edge, right side of stuff, voodoo trickery trade that he spent 8 years learning, right? For Gary, it's that white bar trade. For me, I like momentum a lot, but I also love a trend trade. So you have to ask yourself, what's easy for me? What's the easiest trade for me to take? Guys, and once you know what the easiest trade for you to take, that's the one that you never miss. And then you say, okay, now I can take my trend trade without thinking about it. Right? I don't have to worry about momentum. I'm cool with a clear path. I have expectations. What's that pattern I keep seeing but don't trade? Gino, maybe this is what you call neutral triggers. I don't know. I like momentum personally. That's the one that I never want to live without. But what's the pattern I keep seeing and I don't trade? Let me go take 100 pictures of that pattern. This is the part that you guys don't do. Does it win more than it loses? You know what time of day you need to trade, an exact you'll take based on your rules. I love it. Oh, hey, JW. Thanks, brother. We made it. But isn't that cool, guys? Expectations. You know what, Ben? It's nice to have you here. It really is. And if I can give the dirt on Ben, Ben owned software for quite a while and didn't post, didn't ask, didn't write a plan, didn't do anything. And I believe you walked away for a few years, right? And said to yourself, man, this is some BS. I'm not doing it. And then he recollected and he came back and he formulated a plan. And Ben, you guys don't know this, he kind of pioneered getting everybody into these prop firms. And it was kind of cool. But to see old Ben, new Ben, they're two different people. To see Jen today and Jen, what you're going to be a year from now, will be two totally different people. And everything has to be a chart read. So I want to show both sides of this trade. All right, so you guys are going to love this. I hope you love this. Maybe you won't. So momentum is bad, right? But the path is clear. Momentum is bad. They're two different trades, Vittorio. Well, actually, a trend trade is just a momentum trade using the large chart momentum and a small chart for entry. And then there's about 173 ways to catch momentum that I see people take every day. We'll go to the user guide, and there is. So I want you to see this, guys. At this entry, I'm on the wrong side of the small triggers. At this entry, I'm on the wrong side of everything. Does that make sense? And when I say wrong side of everything, I'm not on the winning side of the triggers. I'm not on the winning side. Does that make sense? Guys, give me a Y or give me a no. And I want you to see the flip side of that. I'm in the momentum phase on two different charts. I'm on the winning side of those small triggers, and it's pretty effortless. And guys, if you don't get anything else out of me today, take this lesson. When you're on the correct side of that fast-moving momentum indicator, it's hard to slow it down, especially when it's on 2 or 3 charts. And then we hit a fib. And look at the bounce right off the fib to the freaking tick, guys. They know where these are. But does that make sense? Is there anything that says this market isn't pushing down? Nothing. And we confirm it. And now it's too soon for a long. So Ben says I'm either going to let it break and then look for a short, or Ben, let it roll and look for continuation to go up to 18,320, right? But in the moment, I don't have the advantages that I need to risk my money. And that's what I want you guys to get out of this class every day. If all you do is speak to yourself in terms of advantages, it becomes difficult to mess trades up. It really does. And the cool thing is, and I think this is pretty cool, you may not, But the cool thing is that I'm going to be here 15 hours a week to help you read your charts, to help make sure that you're reading them correctly, that you are embracing advantages. Paul says when there is a termination condition and I'm on the correct side, momentum phase, I'll take a little snap back and get in. Yeah, don't try to be right. That's it. And then look at that. Weak triggers at an area. Paul creates expectations. It's the same look. It's a different market. It's the same freaking short that we just took. Almost identical. Except Paul has the benefit of the termination condition, which gives him an even better chance of success. Nicely done, Paul. And Paul says it's a momentum style trade. If momentum changes, perhaps he'll exit. Maybe he won't. I don't know. That's up to Paul. Termination for the win, right? And he waited for the mini pullback on the large chart. Guys, so in 2004, Nexgen taught a trade that when an area holds, sell the pullback to small triggers. When an area holds, sell the pullback to the small triggers. It doesn't matter which direction you're going. When an area holds, let the triggers roll, sell a pullback. So here, it's too soon for a short. Triggers have to roll. Here, it was perfect. And look what Paul did. And guys, just a little heads up. 8 out of 10 times, your pullback to the small triggers typically lines up with the pullback to the large triggers on the small chart. Just a little FYI. But guys, the reality is you don't need these momentum trades in the beginning, and you don't need these edge trades, and you don't need to be the first one in, and you don't need to be the last one out. You just got to win more than you lose. So it makes sense to take the trades that win more than they lose until you get comfortable. Nice job, Paul. And I love that. Paul, that's one of my favorite parts about your plan. Paul says, you know what? I'm in this to get paid. They're gonna pay me, and I'm gonna go break even. So no matter what happens, nothing bad can come out of it. And then if we get to 84 to that mid band, Paul's going to be watching, right? It's a beautiful trade. There it is blown up. Pretty cool, right? From 2004, guys. Nexgen's been teaching this one for 2 decades. My brother has pictures of old software with this exact look on it, annotated on this crazy Commodore 64 font. Patterns have been repeating themselves forever. Isn't it cool? It's a nice one. And now you have to manage. Management's the hard part, but when you take the right trades, it's easy to get paid. I think when you take the right trades, it becomes so much easier. Termination. Now we're rolling. I wonder if we're going to get a pullback somewhere by those large triggers, by those small triggers. Should we wait and see? And then we'll call it a day? It may happen. It may not happen. NASDAQ decided that it wanted to go through, right? Strong triggers break things. And then for you range chart traders, that circle that I just made lines up perfectly with an HVA line right at those trigger lines, which means this is nothing more than an HVA trade. But the look is consistent. You don't need an HVA line to know that that's the most likely spot. So That's it. All I'm doing. So what do we see on this chart? We see a termination, right? It's beginning to reverse the market. The large triggers are down. The small triggers are down. I don't have any areas to trade from. This might be one of those times to wait for a confirmation. But we're just waiting, right? Waiting for the best. Because our money's worth it. How'd we do today? Did anybody learn anything today? Anybody have an aha moment?